Shauna Smith alongside of Miles Udland, and this is Yahoo Finance's flagship show, The Morning Brief. Stock futures in the green 30 minutes ahead of the opening bell on Wall Street. S&P futures leading gains while the Dow looking to extend its 8-day winning streak.
And the big story this week is inflation. All eyes on Wednesday's CPI report. But for this Monday morning, let's get to the three things you need to know before the opening bell. Yahoo Finance's Jared Blickery, Madison Mills, and Rick Newman have more.
Futures pointing to a higher open this morning after the Dow saw its best week of the year, ending Friday. Wall Street now looking forward to fresh inflation data on Wednesday. Traders remain optimistic that rate hikes are mostly off the table for the Fed, despite a hotter than expected inflation print that we've seen in recent months. Now, markets are currently pricing in less than 2 interest rate cuts this year per Bloomberg data.
Plus, we'll get a check on the pulse of the consumer. Walmart, Home Depot, and Alibaba are leading a quieter week of quarterly reports as earnings season does start to slow down here. And with the Fed holding interest rates higher for longer, investors will continue to watch closely from those earnings reports for any signs that the resilience in consumer spending is starting to dwindle. That will also become more clear with April's retail sales report.
And President Biden is expected to announce on Tuesday new tariffs on some Chinese goods. The president will hit a range of industries from electric vehicles to batteries to solar power to critical minerals. The announcement would also quadruple tariffs on EVs from China, according to a Wall Street Journal report. That move could raise the tariff rate to roughly 100% from its current level of 25%.
All right, today's top story, crucial inflation data on deck, the latest CPI print out Wednesday. Wall Street largely expecting those sticky high prices to show some signs of easing. Core CPI set to rise 3.6% year over year. In April, that'd be down from March's 3.8% increase. A 3.6% reading would be the slowest annual gain on the core CPI number in 3 years. On the core measure, car insurance, rent, healthcare set to help ease these pricing pressures. Sean, we still have inflation that's going to be, roughly 2 times what the Fed's target is set to be. So you're looking for 2%. 3.6% is, we're going to consider it a victory of sorts, if indeed we get that number. The components that we called out there, particularly the car insurance, is an interesting one because we've seen the last 2 inflation prints, car insurance, come in almost 50-year highs. We know there's some structural problems in the insurance market. As some people say, more and more people are talking about this. I'm not sure exactly if Jay Powell wants to go out there they're not going to cut rates in June, but I'm not sure he wants to go out there in July or September and say, well, we're seeing these insurance markets right size, so we're going to go ahead and cut rates. But it is a growing subtext within the conversation of what would prompt the Fed to cut rates, particularly as we continue to see. Dow's up 8 days in a row. The market's pretty comfortable with the level of rates. They've made their peace. I've said this 1,000 times. They've made their peace with 5 3/8 Fed funds rate, for better or for worse.
Yeah, they certainly have. And we spoke to Mark Zandi about this over at Moody's on Friday, and he was talking about the fact that, hey, that 2% level should actually be increased, not something really revolutionary. Obviously, that talking point has been brought up time and time again. But I think the case, though, for that argument to be made is getting a bit stronger. When you do see the economy remain resilient, when we are seeing some softening within the labor market, but overall, the labor market obviously holding up much better than almost any forecaster had anticipated up until this point. So I think if we do see some improvement, even just marginal improvement, I think it's going to be enough here in order for you can then make the argument that the rate cuts are still on the table. We might even get 2 before the end of the year. And then you have some out there saying that, hey, if we do start to see improvement and consistent improvement, maybe 3 could even be on the table.
And I know we'll talk about this later in the hour, and we'll probably talk about this all week, maybe for the next couple of months. But the whipsaw that we've seen, because now we're going back to this 2, 3 rate cuts. Maybe we're back on the table. It was a week and a half ago that it was like Powell was literally asked about stagflation, not that long ago. What was it, May 1st was the Fed meeting? And so the speed with which we've moved off of that narrative and back, as you're outlining, to what really predominated at the beginning of 2024, I think that the challenge, maybe it's a good problem for the Fed, although some would say there's no good problems. But things got so, let's say, out of hand relative to what they were hoping the market would be expecting. They were hoping the market would essentially just follow the dots and remain conservative. traders got so aggressive pricing out any rate cuts that as the market comes back to the Fed, which is not a situation they have been in recent years, maybe the communications ultimately get a little bit easier. And we're going to talk about the tariffs later on, and Ben Worschkel's done a lot of great work talking about Powell's political predicament, but perhaps the market narrative coming back to the Fed can take some of these political conversations away from them, which is, would be another desired outcome, though, of course. Politics is not factored into
I was going to say, exactly.
They have a creative way of doing that, but official line.
But I do think that also just highlights how much uncertainty there is out there, right? Just in terms of the whipsaw, the fact that the market is quick to jump on almost any sort of tidbit of new information, exactly what that could then mean in terms of the leadership, the rotation, whether or not we could see more broader pressure across the board. So any update on that remains to be seen, but we're going to get the two readings on inflation this week. You've got PPI and then obviously CPI. We'll get PCE again in a week or two. When you take all of that into account, clearly it's coming ahead of that next meeting here for the Fed. We'll see whether or not how much that language is going to change. I don't know though.
Probably not. I think that they made their subtle tweak in May, and then this meeting that we're going to have. It's only 4 weeks from Wednesday, I think. You get the gamut. You're going to get the dot plot. You get the SEP. You get the whole kit and caboodle with the Fed, and so it makes. I don't want to say it makes it easier, but the statement language becomes but one part of the overall communications, where you have the dot plot, you have the economic forecast, you have the inflation outlook, have unemployment, which I think is probably going to be a growing part of this conversation, which is just how much softening in the labor market does Powell not only want to see, but will they accept? And we'll get a sense of that in the SEP.
All right, let's talk a little bit more about this. We want to bring in Nicholas Brooks, ICG Head of Economic and Investment Research, joining us now. Nicholas, it's great to have you. So I'd love you just to weigh in on what Miles and I have been talking about here this morning. Clearly, when you take a look at where things stand now, there is this expectation that we will see inflation moderate here later this week on the next reading. To what extent, I guess, are you expecting to see that moderation, if at all?
Yeah, I mean, of course, on a monthly basis, it's pretty hard to forecast the inflation numbers, totally accurately. I'd say that, really what I'm going to be looking at, and I think, frankly, most people in the market are going to be looking at, is that core services number. So, we know that, there'd been a pickup in oil and gasoline prices. So that's probably going to have a slight upward, put some upward pressure on the headline number. Core rates may be affected by some of the factors you were just talking about, car insurance, et cetera. But I think really the real focus, because this is sort of the area where inflation has been most persistent, sort of very worryingly persistent, is in the core services number. So as I'm sure you know, on a year-on-year basis, that's been trending up since October, running at around 4.8% now. And again, as you highlighted earlier, the official target is 2%. So we're well away from that. So it really puts the Fed in a bad place, because I think, they keep emphasizing that, rates are actually tight. Based on what they think a neutral rate is. No one knows what it really is, but where they estimate it is, that policy is actually tight. So I think they would like to move towards easing. But the problem is when you've got core services running at 4.8%, and, again, as you highlighted earlier, that just the traditional core rate, ex food and energy, is running, at around, 3.6, 3.7%. It's very hard for them to start signaling that, they're ready to ease.
And I guess, Nicholas, on that point you're making about the core services number, we've seen that annualized rate, whether it's a 3-month, a 6-month annualized rate, really accelerate. Is the Fed at risk of ignoring an inflation acceleration? And what I mean is, Powell went out in March, I think it was, and said, we don't want to ignore data, or maybe it was April. We don't want to ignore data we don't like, but is there a point at which there's a preponderance of data they can't ignore on the inflation side, and that core number, by coming down on Wednesday, might actually be sending an incorrect signal about the real kind of inflation picture overall?
Well, that's a very good point. And again, the Fed, I'm sure, is looking at 3-month and 6-month annualized rates of core services along with everybody else. They may not talk about it that much, but I'm sure they're watching that pretty carefully. And I think one of the problems with this cycle in particular, having had the pandemic and, energy crisis, with the Russian invasion of Ukraine, a number of other factors, is nobody really knows what's going on, including the Fed. I mean, anyone who's been trying to forecast inflation, including the Fed, has been burned multiple times through this cycle, always saying, yes, now it's time for inflation to start coming down. We'll be easing soon, we hope. The so-called Powell pivot back in December. Markets rally off it, credit spreads tighten, and then that actually has a stimulating effect on underlying economic growth. And so I think the issue we're in the situation we're in right now is that no one is really sure about which way, how persistent this core services inflation will be. And therefore, I think the Fed, having been burned a few times, is going to be super careful about hinting at rate cuts anytime soon again.
And then moving, the complement to inflation is what we see in the labor market. And we continue to get fairly strong, fairly steady labor market readings. I'm just curious, both your read on the labor market right now and also how the Fed kind of squares, again, a very clear easing bias with the notion of a labor market that is continuing to add roughly double the replacement rate of payrolls to keep unemployment flat, et cetera, et cetera. I'm just curious where you see the labor market at this year and maybe through the balance, or right now through the balance of 2024.
Yeah, I mean, in a way, the Fed and everyone else who's been forecasting inflation to stabilize and come down has been very lucky, because we've had pretty strong immigration, much stronger immigration into the U.S. than was expected, and therefore we've managed to be able to see pretty strong payroll growth without the kind of significant upward pressure on wages that we might have seen. So actually, in a way, we've been lucky because of this high immigration. Now, to the degree that might slow, and the economy continues to move along at the pace that it is, there's a risk that we don't start to see, the easing in wage growth that everyone is forecasting, and the Fed has to stay higher for a lot longer. And I think, just going back to why do they keep and why do, most forecasters keep expecting the Fed to get ready to ease? I think it always goes back to the idea, the concept that the Fed is actually that policy is currently tight because the Fed rate is well above the estimated neutral rate. But the problem is no one knows what that neutral rate is. It's very theoretical. And that goes back to, where should policy end? What is the ultimate terminal rate for policy?
Yeah, and we've seen some Fed policymakers come out and start to talk about the notion of a higher neutral rate. We'll table that for next time. Nicholas Brooks, ICG, Head of Economic and Investment Research. Thanks for the time.
Thank you very much.
All right, President Biden expected to announce new tariffs on Chinese electric vehicles this week. That's according to several reports. Total tariffs on the sector will rise reportedly from 102.5% from 27.5%. Yahoo Finance's Rick Newman joins us now to discuss. So Rick, two parts to this. First would be on exactly what we're hearing will be in the EV part, but really overall what the status is of U.S. economic policy as it relates to tariffs on Chinese goods, really between the Biden and the Trump administrations.
Well, let's keep in mind there are almost no Chinese electric vehicles on sale in the United States right now. So this is not going to raise prices on any vehicles that Americans are actually going to go out and buy. The main point here is to keep those electric vehicles, those Chinese-made EVs, from coming into the United States in the first place. And they're cheap. I mean, you can, if they were allowed to come in at a normal tariff rate, even at 27.5%, which is the current rate, you could buy one of those for about $12,000. So would people buy those? I don't know. I think some people probably would. But the point is, keep them out in the first place to protect the domestic auto industry. So that's point number one. Point number two is, look, we're in a new era of industrial policy. I mean, this is protectionism. So what Biden is doing is different from what Trump did. Trump did those across-the-board tariffs. Biden is targeting certain industries that he wants to develop here in the United States. And this lines up pretty cleanly with the incentives that were in the Inflation Reduction Act from 2022. So Biden says we just need to develop domestic supply chains for electric vehicles, green energy technology, and a few other things. And that's what this is all about.
So, Rick, I guess building on that a little bit and just talking about the fact that this is mostly, then it sounds like, just symbolic here for the Biden administration to impose this. What's the risk, though, in terms of that retaliation and what it could look like here from China if they do have a response?
I mean, the history of trade policies like this tells you that the country on the receiving end is going to impose some sort of retaliatory measures that are basically equal to whatever we impose. So the problem that China has is, they don't import nearly as much American stuff as we import Chinese stuff, but they do buy a lot of American agricultural products. So, I mean, the playbook here is when Trump imposed all of his tariffs, China retaliated by adding new tariffs on American pork, American soybeans, and that was a real struggle for farmers. So that could happen. I don't know if it will, but China will retaliate. The question is, will it be enough to hurt American producers? And we just have to wait and see what's going to happen. But there will, look, this is a very tense trade relationship between these two countries.
All right, Rick Newman, thanks so much for taking the time to hop on with us this morning. Always great to get your insight.
Bye, guys.
Here. We're just getting started here on the Morning Brief. Coming up, Roaring Kitty is back. Keith Gill, one of the main faces of the meme phenomenon, making his first social media post in 3 years. Shares of the meme darlings, they are jumping here this morning. We are going to discuss after the break. Plus, one stock was worse than the rest. We will bring you the one stock that dragged down the S&P 500 earnings growth by the most here this season. And later, it's all about inflation this week, but what are the different ways the data is measured? And what does it all mean for the Fed, and how does it impact you? We will explain on wealth in our 11 a.m. Eastern Time hour. Stick around. We'll be right back. SoftBank posting a full-year profit in its Vision Fund for the first time since 2021, boosted by its investment in ARM. Now, the company's 90% stake in ARM now accounts for almost half of its entire portfolio. So a lot of this and the resurgence that we've seen around SoftBank here, at least in the last quarter, has been surrounding ARM Holdings and the lift that has then provided here for earnings. And they're looking here to leverage ARM technology going forward. The investment there, some of the funding that they see from there, just in terms of what they plan to prioritize for future investments. And it looks like, at least for now, from this, they're looking to use some of that funding to go after new investments. And you would have to think that a lot of that now is going to be surrounding AI and exactly how that could transform a number of industries.
Yeah, and I think you kind of have two parts to this, where on the one hand, the track record of what Masa-son has done at SoftBank over the last several decades obviously says, great, let's see what happens. There's been some massive, massive winners in that portfolio over time. On the other hand, you look at the way that the Vision Fund, the reputation that the Vision Fund got, over, let's call it the mid-2010s of kind of, WeWork is the canonical example, right? But momentum chasing, let's say the VC, this is the thing, VCs are momentum chasers. They all kind of go into the same thing. Everyone's going into AI now. And I sort of wonder, did you have the hit? ARM has been a huge winner, is probably going to continue to power the gains in that portfolio. Sure, you take those winnings, you reinvest them into other AI plays, et cetera, et cetera. But you look at the success of that, where ARM's not a new company. This is a company that has been in the foundry business for a long time, and there was a bull case around it on the cloud 10 years ago, and that went fine. Now you've got the bull case on AI, and how much more? How many more bets are there to make on AI? And I know, I'm sitting here a year into the AI thing saying maybe it's over, but you just sort of, the more companies that come out, and we've got events this week, events next week, you get to Apple, all this kind of stuff. Okay, so SoftBank's the latest to come in and say we're going to invest in AI? Great.
Yeah, exactly. And I also think the real question here is, are there going to be any new big players within the AI space, or the leaders that we are seeing, if they're going to continue to capitalize, right? Yeah. Because there has been the argument made that we're still in the very early innings. Some are making the case that you're still in batting practice when you get to the whole, analogy with the baseball games. But when it comes to what exactly that looks like 7, 10, 15 years from now, whether or not it's still going to be the small handful, or more than a small handful, a number of companies that are already within this space and clearly have that lead, or if there is still time to invest in some of these smaller players who could potentially benefit here down the line. And I think that's a real question when you're trying to synthesize some of this investor enthusiasm and figure out how much of it is realistic and what exactly that benefit is going to look like.
Yeah, and and speaking of the SoftBank portfolio, let's take a look at Alibaba. That stock is up this morning, about 3%. Results from Alibaba expected tomorrow before the opening bell. We also saw within the Chinese internet space, Tencent Music come out this morning. They had better user growth figures than analysts were expecting. That stock is up 3%. And this kind of pulls back from AI and really just gets to the trade du jour. Speaking of risk sentiment in the market, Chinese internet stocks, KWeb, that index, that ETF, has been up about 30% almost since the bottom in February. It's up about 23% over the last 3 months. You look at these stocks over the last month, and you've just got some huge winners in here. Your Pinduoduos of the world, Tencent, not Tencent Music, but Tencent, that's that stock, the ADR, up 23% over the last month. KWeb's up 15% over the last month. JD.com is up almost 30% over that period of time. I don't think there were a lot of people coming out and banging the table for Chinese internet stocks, but fine. Tell me the AI fundamental case. Maybe there's a notion. We've seen some positive regulatory chatter out of China, but ultimately, when you are looking around and saying, the market's ripping, what's gotten killed, and we kind of did this with utilities last week, what can I buy and take my chance on? You have seen Chinese internet stocks really catch a bid over the last 3 months.
Exactly, and so then the question is, how much more runway is there really left, considering that so much of the fundamentals, there still is a heck of a lot of weakness within that picture, right? Whether or not they're just betting on some of those beaten down names. Maybe you can make a case for, if you looked into some of these businesses, Tencent Media here specifically, I was going through the analyst reaction, and they were pretty much overall optimistic just about the fact that the moat that this company specifically has within the industry, some of that earnings momentum likely to continue here through 2024. So whether or not it's going to be some of these individual names that make the most sense at this time, or whether or not it's going to be that rising tide lifts all boats and beating down, or investing in and buying beaten down names that clearly have not participated in the rally yet. But you got a question.
Call it a meme stock of sorts, meme trade of sorts. Speaking
of, let's move on to the meme trade, because it's back today. It's almost like we're back in 2021. Well, GameStop shares surging over, look at that, 50% here in the pre-market. The stock is up 60% and some in the last month. Roaring Kitty, the account behind GameStop's Reddit phenomenon just 3 years ago, is making his first appearance on X since 2021. And Miles, you were breaking down what exactly this meme means and why everyone is so excited and buying GameStop here and why we're seeing this massive rally. So explain to us what exactly this
means. Let's not make it seem like I'm some kind of meme master. I think this is pretty self-explanatory, but the origin of this meme, as I am to understand it, is from, it actually originated on Twitter some years ago. And, you know, someone's gaming and it's like, now I'm locking in. And we were chatting during the break. This is the equivalent to, I'm sitting here, I'm minding my own business, I'm checking some Slacks, I'm checking some emails. It's like, oh, this guy just messaged me. All right, let's go. Now we're gonna take some time to look at this one. I mean, there's so much to like about this, but really, we just got off the conversation about Chinese internet names. Yeah. We've been talking about crypto over the last month or so. Again, utility stocks getting memed in the last 2 weeks. Now we have Keith Gill coming out of the woodwork to talk about GameStop, a name that underneath the surface, as you noted, you look at that monthly performance, this has been ripping. Now the stock is going to basically be a double over the last couple of months. There's a lot going on out there. It's an interesting, like the speed and consistency with which we have been replaying the hits in this market over the last 18 months since you had that bottom in October 2022 continues to, I don't know, impress, confound. It is the feature. It is the feature of this market.
It is the future of this market. I mean, when you just take a look at even this tweet specifically, when we talk about it, there's a lot of excitement. You can, as you were just noting, you can actually look at a number of different pockets here within the market. But this specifically, this has been viewed over 10.5 million times. Okay, this is the stock that is now surging. It's bringing back the whole meme era. Clearly, if you're betting on this name, you got to be ready to lose it all. That's nothing that's new because clearly it's not. You have to be.
No, GameStop's not going out of business.
Okay, maybe not literally it's going to zero, but it's not going to continue to ride this wave. I think what we learned in 2021 is that you got to be prepared for it to come crashing back down.
I think what we learned in 2021, what we've learned since, and what you see this morning, is there is now real money behind this. This is not just people with Robinhood accounts. There's like institutional traders, pod shops, who are looking at this and saying, this is our opportunity.
But does that change, though, the investment narrative around it?
Well, of course, the charts, I mean, look at the chart. It's a mess. But the narrative is that, like, I would just say there is now a self-awareness when it comes to the meme trade and when it comes to the factors that are not, oh, this analyst had a meeting with management and said they're great. Like, you are now literally paying attention to, Wall Street bets. Of course, that's table stakes. But all these other kinds of sentiment indicators that are out there for real money investors to grab. And this is not just folks who are sitting at home. And I think that is what's the most interesting part of both today's move and the overall shape that markets have taken over the last several years.
And look at that. AMC is also up about 20%.
Of course it would be, because it's a basket, If you're short the basket, well, now you're on the wrong side of it, et cetera, et cetera. So,
all right, we got to leave it there. We've got the opening bell coming up in just about 2 minutes. We'll be right back. And there's the opening bell on Wall Street. This market check sponsored by Tasty Trade, kicking off a brand new trading week, and we're starting the week in the green. All three of the major averages here opening to the upside. We've got the Dow pulled up for you. That's up just about 0.3% when you take a look at the move that we're seeing higher in the S&P 500, pushing further above that critical 5,200 level. And then you've got the Nasdaq up just about here, up about 1% here in early trading as we starting to see that trading action take place. But let's take a look at the sector action, Miles. We're taking a look at a lot of green on the screen.
Yeah, we'll see how we open here. Technology up 0.7, communication services lagging, so I'll check my watch. We'll check back in 5 minutes.
Yeah,
Jared Blicker will tell us how we're doing.
I was going to say, Jared, let's go to you with a closer look here. Now we've got the Nasdaq up just about 0.3%. That looks a bit more accurate. Jared, what do you got?
Well, I was taking a look at the futures here. Let me just pull that up on the Wi-Fi Interactive. Dollar is not doing too much today, and the futures are kind of quiet, but they've been making some really outsized moves recently. So let me just go through some of our big tickers here. So crude oil is one. Crude oil is up about 0.2% today. This is the overnight price action. Not a lot of incremental news here. We are getting some of those production figures for March, where we saw Saudi Arabia really stepped up, whereas the U.S. figures from February, they dropped, and so did Libya. But the price is holding below $80 a barrel. If you look at the year to date, it's been pretty choppy. We've come down to what potentially could be a support area, but I'm not seeing anything too significant in terms of levels. And we got to check out gold as well. Gold is down about 1%, still holding above 2,300. That's emerged as a potential level of interest here. And this is a year-to-date chart. You can see gold is simply consolidating the gains that it's made since it broke out. And just as a reminder, here's a 5-year chart to show you how it broke out. So looking healthy there, just not a whole lot of action today. And then I want to touch on cocoa as well. That's been really on the move. Let's get the year-to-date chart. This move, we're seeing at the lowest levels in, what is that, a month and a half? But this move here on $15,000 margin, you would have made $45,000 if you shorted. That's 3 times your money, a very short period of time, only to say that futures remain very volatile this year.
All right, Jared, thanks so much for breaking that down for us here. We'll see how the trading day shakes out. Let's talk about what is on tap here this week, because we've got the CPI and PPI prints in focus, the latest readings that we will get on inflation, potentially giving us a bit more clarity on what the Fed's next move could potentially be and what that timeline looks like for rate cuts. Now, this coming after the S&P 500 still continues to hold above that 5,200 level, not too far now from the all-time high. The Dow having the best week of the year last week, and we're now moving to the upside at the open, up nearly 0.3%. Let's talk about what to expect. We want to bring in Ben Amons. He is a New Edge Wealth, a senior portfolio manager, head of fixed income and macro here. Ben, talk to us just about how much is really relying on the inflation prints, if at all, and how you think the market will likely react if we do get any sort of hotter than expected print.
So I was looking at the actual estimates of the inflation number, which is really narrow this time. It's like 20 basis points between the high and the low of that estimate from economists. And then I looked at the bond market, and they've priced it exactly to perfection of what the headline CPIs we expected to come out at. And then you have nowcasting of CPI2, which is sort of like a real-time measure. That's also exactly in line. So if we're priced for perfection on CPI, then any type of surprise on that number, whether softer or harder, could lead to significant movement in interest rates particularly. Because previous segment I think was talk about, we keep buzzing every day about this rate cut. Yeah. And these inflation numbers obviously matter a great deal to that, because if this is a softer print than the previous 3 numbers, the calculus again changes. But if it's harder, the trend continues. And so I do think we're going to see some volatility around this number, whether it's soft or hard. I don't know if it's going to be soft or hard. That's a bit of a guess. Yep. The market is sort of trepidating, so there's not much signal that we're getting currently. So we're just waiting here.
So, at a certain point, we can deal with Wednesday when we get to Wednesday. I'm curious, speaking of what's happening in the bond market and sort of the action we've seen, along the Treasury curve over the last month, and really the way that price has perhaps led some folks to think about how they're allocating across asset classes. What's the state of play as we sit here mid-24? You still have 5% on the 2-year, still have plenty of opportunities to get something for nothing, right, if you want to talk about treasuries and cash. what moves have you been making, been discussing most often as it comes to those allocations, which are now, we're a year into a state of play that people didn't think would last too long?
Yeah, the yield curve has actually been very flat and stable. The difference between the 2-year and the 10-year is something oscillating around negative 40 basis points. So you're not getting much reward from being really far out the yield curve. And as an investor, I take note of that because at the end of the day, it's about risk taking in this case of like, if I don't get enough yield for the duration risk, so to speak, I may have to do different things. Now, I was talking to some of our clients and our advisors, our firm, about thinking of duration itself, which is basically measuring the sensitivity of a portfolio when interest rate changes. You have to now think of diversifying duration because we are in an environment, as I just described. If these data points keep throwing us off with volatility going one way or the other for interest rates, then you want to play it more safer. So let's say you want a duration of 6 years. You can do that, but you have to use different pieces of fixed income in that duration to get to 6 years, but have a low volatility portfolio. So what it comes down to is that you probably have to do more shorter maturity securities at this point. You not only get a better yield there, but it gives you low volatility. But then there's emerging markets, there's preferreds from that banks are issuing, there's structured credit, there's ABS. Those are all like securities I think are attractive in this environment. They've been positively returning and gives you a low volatility for the same duration.
And you mentioned emerging markets and it made me think of something else you brought up in your notes about Milken last week. And it seemed like Rick Newman made this point in a column. Several other outlets made the point that everyone was cheering the U.S. economy. Everyone was super excited about investing in America. Yeah. What do you make of that kind of consensus overweight to the U.S. in the context of global investments? There was a big story in the FT over the weekend about will Europe ever catch up to the U.S. economy? And everyone's kind of contrarian, I think signals are going off.
Yeah, it's a productivity miracle that we're dealing currently with, or at least we're anticipating it, with all this AI hype and the money that's spent on it. Look, we have a stronger economy because I think really that in the early days of the pandemic, part of the country just reopened without having any kind of acceptance of the pandemic being there, so to speak. And I think that was really that mattered today even. And which is all the Sun Belt states. And then we got the stimulus, not just the spending stimulus, but the Infrastructure Act and the Inflation Reduction Act. That sounds political, but it does have a real impact on the economy currently. That's actually driving the productivity to an extent. I think this is why people are looking at the US of this difference of growth versus Europe that does not have as much productivity growth currently. And the lawmakers in Europe are concerned that productivity growth is too slow. And I think this is why people like the US. But to sustain it, this was the other big theme at the Milken conference, like everybody wants a rate cut. Because if we don't cut rates at some point, then we cool off the economy too much and that productivity miracle may disappear. So I think the enthusiasm for the US will remain, and it will remain well into the election. After that, we'll see. But I do think it's the outperforming economy.
And speaking of enthusiasm, let's talk about the meme stock move that we're seeing here this morning, because Miles and I were talking about this massive run-up that we've seen in GameStop, a lot of it on the heels of this tweet that we got out from Rory and Kitty over the weekend. But I'm curious from your perspective, this hype, this mania that we're starting to see resurface here with some of these meme trades. Is it going to play out differently this time? Is some of this, do you think, have maybe a bit more staying power than what we saw a few years ago?
Well, on the one hand, the meme stocks were always interesting about the reopening of the economy, like that company that you mentioned. I mean, the fact that malls went open, everybody could go back into a GameStop store, and it allowed GameStop actually to have access to capital markets and have capital and then invest in his business and recover. That was part of that initial meme stock, and then it became speculative and everybody jumping on it. I think this latest move, I guess, is again enthusiasm of taking risk and some level of speculation as we're sitting here sort of in a low volatility environment waiting for any kind of signal from the Fed or the election or the economy. And it drives people to potentially trading again. So I'm not surprised, right, in a way. This is one company, you get a bunch of other of those. Are they investable stocks? I think you need to do your homework on the companies in and by itself. I would advise, we're not analysts on it, but I think broadly speaking that it will always be part of our markets now. People have learned to trade. There's enthusiasm about taking option trading on, and all these retail brokerage firms offer that, right, in order to trade options, and people look at it as an income generating too. So I think that's part of what's playing out here.
As we enter the 5th year since the pandemic started, to sit here with 5% rates and talk about a low volatility environment, it's really amazing how far we've come. It feels like we're back in 1920, pre-pandemic to some extent. Ben Eamon's always a great conversation. New Edge Wealth Senior Portfolio Manager. Thanks for stopping by. All right, coming up, Apple's big push into AI expected. More information on that next month. Tech giant reportedly inching closer to a deal with OpenAI. We'll talk about what it means for Google coming up next. All right, Apple is reportedly closing in on a deal with OpenAI to include its technology on iPhones. That's according to Bloomberg. The companies are looking to finalize terms to include ChatGPT on Apple's next OS, iOS 18, according to that report. A couple of things here stand out. We see Apple stock up about 1%, so outperforming the broader market early here. We have WWDC early next month. Apple has been, it's been a year and a half since everyone's getting on the AI train. But if there's a laggard, we're able to talk about there being laggards, Apple has been the laggard on that front. But what stood out to me from this report is two things. There's the obvious, which is, well, Apple and Google are search partners, so tough that Google is not part of this agreement. But Apple is a tech company, but it's all about the brand. Like like their branding is the thing, which is of course the ad last week, et cetera, et cetera. ChatGPT is the main AI brand. So I know that people are going to come out of the woodwork and debate what the best technical AI chat, large language model, language learning model, large language learning model, whatever. We're going to debate what the actual technical best one of these is. Right. But when people on the street you say AI, anyone who gives you an answer other than I don't know what that is probably going to talk about ChatGPT. And that's a very strong brand to have at this stage of the cycle. And that was my kind of big picture takeaway here for Apple thinking about an approach to
You're saying
AI.
it makes a heck of a lot of sense.
Well, it makes sense. I think, again, really tough for Google, who's been their search partner, who is trying really hard, and they're going to try hard this week at their event to talk about all their AI things. But if Apple is like, we're sort of agnostic on whether AI actually works. Like, I don't know how much they care about your prompts in iMessage being good or you even using them. But if they want to come out and make a splash, it makes sense at this stage in the game to be like, we partner with ChatGPT. They're the ones.
Yeah, it does. And I think that's also the argument that a lot of analysts are making this morning and have made ever since reports of this started to surface late last week. And they were talking about the fact that maybe this is what is necessary in order for Apple to have a blowout quarter coming up here later on this year when it comes to the next iPhone cycle. If that is going to be what it takes for people to eventually upgrade their iPhone. And I think the case is out on that because I think the use cases, the personal use cases need to be developed just a bit. Like I still think, I wonder honestly how many people use ChatGPT, not only on a daily basis, but more so even on a weekly basis, and whether or not some of that excitement is going to be enough in order for them to go out and spend $1,200, $1,300 on a new phone. But I do think it does make sense, one, because Apple has largely been criticized for the fact that it hasn't jumped in more aggressively into the AI push up until late. So I think they can put to rest some of those fears out there. But two, I think even beyond that, the fact that they are teaming up with OpenAI, like you are saying, with ChatGPT, that is the household name when you are talking about AI. That does make sense if they are looking for any sort of push, which I think they could get here.
I mean, I think sometimes about like family group texts.
Yeah.
I wouldn't be opposed to having an AI write responses to that.
Yeah.
Like, do I have to? The AI equivalent is someone sends a picture, you give it the heart reaction. It's basically, I'm not acknowledging this, I don't care, that looks nice. So would AI, like in that setting, fine. Because I'm notorious non-responder to like all kinds of texts, but in particular like family type group chat things. You fire off an AI,
but what if it's a text that so the picture, I don't really think
if I care, I'm going to respond. But most texts I get, I don't care about. So then, having ChatGPT would, I mean, I'm not going to go buy an iPhone because of this. I'd buy an iPhone because it stops charging, which it does every 2 years. So that's why I need to buy an iPhone. But like, I think there's plenty of uses.
Yeah. I don't know. I upgrade my iPhones probably like once every 4 years.
Are you going to use ChatGPT to reply to Mark?
Probably. I mean, honestly, it sounds convenient sometimes if you don't need to read every single text.
See what I'm saying?
But it's not going to be enough, at least for right now, for me to get off the sidelines and upgrade my phone.
I've literally heard enough from you. Let's do the ChatGPT.
But we'll see how it plans to monetize AI
All right.
here down the road.
Coming up, S&P on pace for its highest year-over-year earnings growth since the second quarter of 2022, but it would be even higher if it weren't for one company in one sector. We have the details coming up next. All right, now that 92% of companies in the S&P 500 have reported earnings, let's talk about the performance of the index overall. It's on pace for its highest year-over-year earnings growth since the second quarter of 2022, but it would be even higher if it was not for one company, and Josh Schaefer is here to tell us. Well, the banner told us, but you'll tell us more.
Bristol-Myers Squibb, right? Of course, the earnings call that we all followed very closely over the last couple weeks that we really had our eyes on is what dragged down the index. I think you guys were probably with me in being a little bit surprised in seeing this stat overall. So Bristol-Myers Squibb is in the healthcare sector, and really the big thing that stuck out for them here was they had a one-time loss that they reported. They don't think this is going to be a continuing issue. This had to do with an acquisition, but they reported an earnings per share loss of $4.40. That was compared to $2 earnings per share in the positive going back a year ago. So a massive loss. Then when you take that and sort of extrapolate it to the S&P 500 growth, their big loss leads you to a massive decline in S&P 500 earnings growth. So you go from what would have been 8.3% earnings growth for the S&P 500 down to 5.4% just by taking out Bristol-Myers Squibb. Now, if you also took out a couple more companies in the healthcare sector, you would actually have even further earnings growth. So if you took out Gilead Sciences and you took out Pfizer, you would actually have 9.7% growth for the S&P 500. So really, the healthcare sector's 25% negative earnings growth kind of weighing on what.
Yeah, when I saw this chart in your week ahead post, I literally didn't believe it. And I was like, this guy.
I thought it was wrong.
I was like, this guy screwed something up. Now we're gonna have to do a big fix. This went out as an email. This went out all kinds of ways. And to put some numbers, when we do the earnings per share here, you know, the $4. $4.40 on an adjusted basis. The unadjusted number is $5.89. That's an $11.9 billion loss, to put dollar figures around it. On an adjusted basis, $8.9 billion loss for BMY in the last quarter.
The stock's only down 10% in the last month.
So it was somewhat priced in.
It was
a little bit priced in.
But with the three stocks we're talking about too in the sector as a whole, that was sort of interesting as I started looking into this more, is you see this and you see the big healthcare decline and you think, oh, probably one of the worst performing sectors, at least in the last month, right? No, healthcare is actually outperforming the S&P 500 in the last month, marginally, 1.4% compared to 1.2% for the S&P. But I think a lot of that has to do with when you look at what happened this quarter, it's not really expected to happen next quarter for the sector.
Well, and also if you look at XLV, I mean, Eli Lilly's 12% of the thing. Yeah. Plus, Eli Lilly, United, and J&J, that's over 20%, it's almost 30% of the ETF right there.
What are the expectations then for Q2?
For Q2, 17% earnings growth year over year for healthcare. It would actually be the second best performing sector in the S&P 500 in the coming quarter. And I do think it gets to, with healthcare, the most interesting part of the sector to me is just there's only a couple companies there that are really, really interesting, right? And they all have to do probably with GLP-1s. Yeah. And then the companies that are dragging this down actually have a lot less to do with the hot trade in the sector. And so you kind of look at it and you're like, oh, well.
And I think, the healthcare and utilities is in this bucket as well. I know I've brought up utilities like 5 times this hour.
You can help yourself.
These are defensive, all else equal. These are defensive type sectors. And in this market, they've turned into growth sectors, basically, right? Utilities are now an AI play with the new data centers and power and all this kind of stuff. And, if there's a non-AI meme trade out there, or, it's GLP-1s.
Well,
and that sits within healthcare.
To take it a step further, too, on the utilities thing, it was interesting with talking about earnings. And, okay, we can explain healthcare maybe not trading off because Q2 is supposed to be good. Yep. Utilities is the third worst performing sector in earnings this quarter. It's also supposed to be in the bottom 3 next quarter. And so I think over the last week, we've been trying to reason, why is the sector moving so much? And we got to this, well, they're undervalued. People are seeing opportunity there. I think there's a big part of the AI trade in that too.
Absolutely. Yeah. Absolutely. I mean, we sat here at the beginning of the year, why are industrials ripping? And it's like, I don't know, is Trump going to win? Is he going to build the walls? Like, no, this is probably an AI related trade.
Energy.
Everything's AI.
Healthcare could be AI, right?
Unless it's Ozempic. It's either AI or GLP-1s.
But healthcare has both working for it.
Yeah.
You could get to the AI trade in healthcare too.
You can use, yeah, sure. We'll leave that to
those that are betting on it are hoping they can.
You can use AI to prescribe more GLP-1s.
It's probably going to happen sooner than you think.
It's probably happening right now.
Right,
I just got a prescription.
We got to leave it there, Josh. Thanks so much for hopping on set here with us. Coming up in the next hour, new show, Catalyst. We are going to be breaking down what the upcoming inflation prints mean for the Fed and for the markets. Plus, retail is in focus this week. We've got earnings results on deck here from Walmart and Home Depot. What that's going to tell us about consumer and spending. We've got all that and more. Miles, you're out of time.
I'm out of time. I got another job to do. Unfortunately, I would love to do this instead.
All right, guys, we'll be right back. I'm Shauna Smith, and you are watching Catalyst. It's Monday, May 13th. Let's dive right into what is moving markets here this morning. The biggest catalyst for the markets this week, it's going to be on Wednesday. We've got the April CPI print that's set to be released. Investor optimism surrounding easing prices may be enough here to boost the probability of Fed rate cuts before the end of the year. An EV war is heating up, with the U.S. expected to quadruple tariffs on Chinese electric vehicles this week. The announcement could potentially have an impact on some of the world's largest automakers. Plus, the weakening consumer, that could be a catalyst here for retailers and the Fed. We're also going to be getting the latest insight into consumer spending with results from Walmart and Home Depot this week, plus retail sales. That print is going to be out on Wednesday. Let's start with the biggest story of the week, and that is the CPI print that's out on Wednesday. The latest reading on inflation, core inflation, is expected to rise 3.6% on a year-over-year basis. That will be a bit of a slowdown here from the hot 3.8% increase that we saw back in March. Joining me now to discuss what all this means here for the markets, we want to bring in Josh Schaefer, standing right to the right of me. And Josh, just talk to me about these hot prints that we have gotten, how the market has reacted, and maybe what that positioning then tells us ahead of the report on Wednesday.
The CPI print has really been one of the bigger market moving to the downside data releases we've had thus far this year, right? So we talk a lot about how PCE is the Fed's preferred inflation gauge, right? But PCE comes out at the end of the month. And so in some ways, economists have been able to take all the data from the month and extrapolate that to an end of the month prediction. And PCE has been coming in hotter than expected, but also largely in some ways priced into the market. CPI has been a little bit of the leading indicator here with inflation that's been coming in hotter than expected to start the month, sort of setting off markets a little bit. It actually didn't last month. I was looking back on it, which was interesting, but it did 2 months ago. So we got into a little bit of a trend of, okay, maybe this just isn't going like we hoped. And last month's reading didn't fully set off stocks, but it has been probably the bigger market moving inflation release, even though it's not the Fed's preferred gauge. But it is certainly big when we talk about overall Fed pricing, right? Where people are expecting rate hikes to end up. And if we're going to get rate hikes, of course, it seems like we're going to need this number to start coming down a little bit more. And I think the key with this week, Sean, is it seems like this is where people think we're going to kind of round the corner, right? And core CPI is going to fall a little bit more than it has been. Okay, maybe now we're starting to see that decline that we hope would happen earlier this year. This is sort of the start. So then if it doesn't start, I mean, how long are we going to hold on to that narrative, I think becomes perhaps the larger question.
Right, and I think if we do see maybe a bit of easing and we do see it come down maybe a bit more than even what the expectations are, or even in line with expectations, my question, because I know you've been digging through many of the strategist notes that we have been getting out in recent weeks, just what does that put on the table then potentially for the Fed? Does that then potentially make the case stronger that we could see multiple cuts before the end of the year? You would think so.
The team at Morgan Stanley, Ellen Zettner, says that she thinks that we'll see 3 cuts still. If it's in line with their base case, which is about where consensus is for this print, it would set off, again, it sort of sets off the rest of the year, right? If we get CPI to start falling, then we might get there. And I think that would be interesting. I mean, 3 cuts still seems pretty optimistic, I think, at this point. That is not where the market is currently pricing. But I think that's kind of the big question right now. You're entering this report at somewhere between 1 to 2 cuts in market pricing. Does it push over to 2 to 3? And does that help maybe some of the interest rate sensitive sectors is probably what to watch on Wednesday.
Yeah, exactly. What that influence or how that could influence here market leadership then when you talk about maybe potentially the next leg higher. And it wasn't that long ago that we were even throwing around the potential for rate hikes. So, I mean, the narrative changes very quickly.
Very
so
quickly.
Very quickly. All right, Josh, thanks so much. Well, stocks are climbing higher this morning, continuing to recover here from what had been a downbeat April. The S&P 500 up over 3% so far this month on strong corporate earnings that has helped really drive the recent gains that we have seen. The index up 5.4% on a year over year for earnings growth so far this quarter, the highest growth rate that we have seen since the second quarter of 2022. This is according to latest data out here from FactSet. So can this momentum continue as big box retailers report this week? We want to bring in Michael Ryan-Ging. He is at NYSE's senior market strategist. Michael, it's great to have you here in studio with me. So talk to me just about the setup here for this week, because we have a couple of critical earnings reports that are out on deck when you talk about Home Depot and Walmart. You've also got the CPI print. So what does the setup look like and some of the trading action that we can see?
Yeah, so I mean, thank you very much for having me here in studio. Yeah, it is a pretty interesting week, right? So we do have an options expiration week as well, right? And if you think back to where we were coming into last options expiration, we were starting to see kind of volatility start to pick up, right? That kicked off a little bit of a deleveraging that happened kind of throughout the marketplace. And this time around, like, we have positioning that's more normalized and right, we're not really stretched in either direction particularly. And we have obviously, as you pointed out, some really key economic data, both from the growth perspective and the inflation side of things, right? And so looking at that inflation side, right, where the Fed kind of set up, just a couple weeks ago, where they said we're really squarely in this wait and see, kind of sort of moment, right? That does seem to me suggest that you have, a little bit more asymmetric risk to the upside from a market perspective if we were to get a little bit better than expected, kind of inflation report, because they raised the bar so high for potential rate hikes, right? As you just mentioned, right? That's kind of come off the table now, right? So it does seem like we're a little bit skewed to the upside, and then we're watching the retail sales for the growth side of the equation.
What do you expect to see there?
We're going to see I would expect to see, kind of a moderation, kind of on that side of things as well. And I think markets and investors are will actually kind of applaud that, right? Because we've seen in past months where when you've gotten those really hot retail sales numbers, right, that suggests that the economy is starting to potentially reaccelerate. I think markets are want to see that moderation because that's kind of the precursor to seeing that disinflationary process start to play out, right? And then as you start to listen to kind of those conference calls, you're going to want to hear, that we're not seeing necessarily a spread of kind of pain, kind of across the wage scale, right? So that it's still, kind of staying in the lower income and it's not necessarily spreading higher. And then, even the retailers are going to give us some pretty good, insight into kind of the inflationary backdrop, right? And just listening to commentary from kind of Walmart and hearing how they see, kind of prices starting to move throughout the remainder of this year. And they suggested in their last quarter, right, that they saw some disinflationary pressure.
So then if we do see maybe a little bit of weakening when it comes to consumer spending, obviously if we do hear any sort of negative or any sort of cautious commentary out of some of the retailers that we will be hearing from, what is that then going to do just in terms of pressure, or maybe more pressure overall that we could see here for other consumer discretionary plays?
Yeah, and like we've said, we're seeing kind of this moderation, right? And that's okay, right? It's like we've seen kind of a lot of spending that's kind of shifted out of goods, into the services side of the equation, and we do want to see some moderation, right? That's really the key when you come back to this inflation conversation, right? Seeing some moderation on the services side, right? We've started to see, some pressure, kind of coming from the food companies and Starbucks and McDonald's, pointing to some, shifting consumer behavior. So, I mean, we do want to kind of continue to see that, moderation happen.
What do you think the narrative is overall, just in terms of the confidence that still seems to be within the market that we are going to achieve this soft landing? And maybe like you were saying, just this risk here more to the upside, that there is still a buying opportunity right now, especially when you take a look at some of the rotation that's happening within the leadership. Yeah,
so when you take a look at, kind of the situation, right, and in the fact that, we're seeing, sorry, I lost my train of thought there. We are starting to see, right, a little bit of slowing on the growth side of things, right? So that is, kind of the prerequisite to seeing that disinflationary process, really start to play out. I think, investors are willing to tolerate, right, a little bit of a slower economy, a little bit of a higher interest rate environment, right, as kind of as long as that higher interest rate environment is happening for the right reasons, in that we have kind of a stronger economic backdrop. It's not happening because we have that inflationary kind of impulse or a reacceleration, kind of on the economic side of things, right? And I think, as we kind of continue to move forward here, the real kind of question is, do we start to see volatility pick up again if we start to see that slowing? Because that we're kind of starting that descent into potentially that soft landing, right? But it could ultimately turn into something more ominous, right? And we want to see how that progresses over time, and then that volatility would come in the form of a growth scare.
Michael Reinking, great to have you here in studio. Thanks so much for joining me here this Monday morning. NYSE's senior market strategist.
Thanks for having me.
All right, well, consumer sentiment, it tumbled on Friday as higher prices continue to weigh on shoppers. So far this earnings season, we have seen rising prices force consumers to pull back on spending for fast food. And now with the big box retailers like Home Depot and Walmart reporting this week, will we see a continuation of that trend? That's what everyone wants to know. We want to bring in our very own Brooke DePalma, the best person to ask here within this newsroom. Brooke, give us a sense just of what those expectations are and whether or not we are likely to see any sort of material weakness.
Yeah, everyone's really wondering where exactly consumer spending power is right now. And certainly what Wall Street expects is that Walmart has been able to hold on to that momentum that it's gained in the recent years. Home Depot, on the other hand, we saw such a hike during the pandemic with those DIY projects. And now Wall Street is expecting that to be a bit of a pullback this quarter. But the professional side of things at Home Depot expected to do well. And taking a closer look at Walmart, Wall Street does expect a 3% sales growth here in the U.S. with gains across all income cohorts. And that's something that Walmart has been strong on in recent years as both low income and high income shoppers look to Walmart for that low price everyday strategy. And what we've seen is that Walmart has introduced things like new private label brands called Better Goods. That's a higher quality, roughly $5 price point
new private label brands in order to entice and keep those high income shoppers that they've gained, especially those who are going to Walmart for groceries. And what we've also seen is the company do that $9 billion store makeover, really hoping to engage income cohorts and really get that experience that they're looking for while also shopping on a dime. Now, Home Depot, a bit of a different story there. Wall Street does expect a 2% sales drop, and that's really because we're seeing tough comparisons compared to what we saw during the pandemic when everyone was flocking to the home improvement retailer to make adjustments, make improvements, redo their house while they were at home. Now, inflation, higher interest rates, as well as soft existing home sales really weighing on that customer that we saw boom during the pandemic. But one point to make here is that Home Depot is really relying on that pro side of things to boost this upcoming quarter. Wall Street really depending on that. We did see them acquire SRS distribution during this quarter, and that's really this, they're really leaning on this pro customer like roofers, like contractors, in order to offset that pullback that they're seeing in the everyday consumer.
And Brooke, how does this stack up to some of the other names within the space? Obviously, the rival being Lowe's there, but in terms of what we could learn here from Home Depot, maybe what that will tell us or give us a better sense of some of those results that we'll see later on this earnings season.
Yeah, well, two others that I'm looking for is Target and Lowe's. They're also expected to report later on. I think when it comes to Lowe's, Home Depot, Wall Street really pointing out that tough January weather, which we heard also from fast food companies, customers really pulling back on perhaps going out and spending. So I'm eager to hear if that's something else that Lowe's will have an impact on. And then as far as Walmart compared to Target, Target is expected to come in with a slight boost, roughly 1% sales growth this quarter. But Target just has not been able to maximize as much as Walmart has on where consumers are seeking value and really taking advantage of that low price strategy that seems to be working for Walmart right now. So it'll be interesting to see if Walmart was able to hold on and if Target was able to gain back a bit.
And they're always a bit more relying on the discretionary purchases, which we know have hurt them in recent quarters. All right, Brooke, great stuff. Thanks. Keep it right here on Yahoo Finance. Coming up, Intel reportedly in new talks with Apollo for a new chip plant overseas. We will tell you why this is a big deal for the company. You're looking at shares up nearly 4% in early trading. We'll be right back. Let's do a check of the market sponsored by Tasty Trade. You're looking at early gains here about 46 minutes into the trading day. You've got the Dow up just around 92, the S&P up about 0.1%, but still adding to last week's move to the upside that we saw, and the Nasdaq up just around 0.3%. When you take a look at the sector action and some of the leadership that we are seeing there, almost every single sector here in the green, except for communication services. That sector off about 0.6%, but we are seeing some leadership from consumer discretionary, utilities, technology, real estate early in the trading day. Well, let's kick it off with one of the big movers here this morning, and that is GameStop shares surging over 70%. It was then halted for volatility. We're looking at gains of about 71%. Ahead of that, Yahoo Finance's Jared Blicker has been closely tracking this action. Joining us now, and Jared, Miles and I were talking about this resurgence that we've seen in so many of these meme names. A lot of the move that we're seeing in GameStop here tied to a tweet out from a Roaring Kitty, who was infamous back in 2021 when we were initially talking about some of these meme trades here. But again, enough for some buyers to be jumping back in.
I'll tell you what, I think we were kind of due here for a little bit of a bump. I was writing about meme stocks a couple weeks ago in the morning brief, and they've just come alive, but at random times. Now, last year and the year before, when you saw these meme stocks surging, that was a good opportunity to short the market because they were the laggards. But this time, it seems to be that they have a mind of their own again, not really acting on fundamentals. And guess what? That's what we're used to. So here's GameStop going back 5 years. Here is the 2021 phenomenon that we saw. That was in January and early February. Now, we just got a spike here that is the biggest percentage-wise. We were up over 100% here before the last pause. That was the biggest jump since February of 2021. So we're right back in the thick of it. You notice that over time, these spikes were getting smaller, and now we have the first break to the upside. So question for me is there more to come? And just based on our history with what we know about meme stocks, that is a possibility. I'm going to sort by performance here, and we can see it's kind of hard to read, but GameStop is up 80% cost. Remember cost? That's up about 40%. Tupperware up 20%. AMC Entertainment and AMC Networks both up 14%. So it reminds me of 2021.
It certainly does, especially the dramatic moves that we are seeing here. And as we have been talking, GameStop here, trading has resumed. And like you just said, now up just about 79%, right? A name to keep on your radar. Let's talk about Kenview. Now, we're seeing not as dramatic of a move, but again, a move that is worth noting here, up just about 0.5%. Now, the company on the move after Johnson & Johnson saying that's going to sell its remaining 9.5% stake in the company just a year after Johnson & Johnson's spinoff. And Jared, when you take a look at this move, exactly what this means ultimately here in the longer run, we had the stock had been under pressure ahead of the open here, but now it looks like we are trading just slightly to the upside.
Yeah, this is a stock when it split off from Johnson & Johnson. There were high expectations, but it's pretty much sunk since that spinoff. Now, this was an expected move. J&J was expected to get rid of its remaining shares, about 10% of the company, 182.3 million. And this is done through a secondary offering. It's important to note that this is not, that the company itself, Kenview, is not going to get any money from this sale. Now, I do have a market reaction by Bloomberg Intelligence here, and you can see that's today's price action. Let me just put a max chart so you can see what it's done since that first trade. Not a lot of green there from inception. But I do have this from Bloomberg Intelligence. The exit of J&J's 9.5% Kenview stake via a debt for equity stock that enables leverage to be reduced as initially planned, removes share overhang. So this was something that was already planned. The fact that it has been executed now just is kind of like a potential share overhang that is in the rearview mirror, and we'll have to see what comes of it. But here's another thing that Bloomberg Intelligence is noting. They're facing second quarter headwinds. This is Kenview. They have yet to prove execution fixes can reverse U.S. market share losses. And so the key to achieving growth with Sanofi's consumer health spinoff next quarter, fourth quarter or later, that's going to add competition as well. So just lots of moving parts here in the biotech sector.
Certainly are a number of headlines that we need to keep our eye on here. All right, let's also talk about another mover here, this time within the tech space, and that is Intel. That stock on the move on the heels of a report that we're getting out from the Wall Street Journal. Now, within that report, the company nearing an $11 billion deal for a chip factory in Ireland with Apollo. Now, this, of course, we want to know Apollo is Yahoo Finance's parent company. When you take a look at shares of Intel, that's up 3.5%. And Jared, this would be a move here, at least in terms of Intel. Intel has been looking to expand its production lineup, obviously, so this would help them ultimately maybe better compete with some of their larger rivals out there. When you take a look at Taiwan Semis, also Samsung Electronics. But I think the timeline of this is what is in question here, and then also that price tag. So clearly the funding from Apollo would be welcome news here from investors.
Yeah, these are just some eye-watering numbers, and this is not in isolation. There are lots of these deals going on. Just a quick history here, because the race is on for foundries, for building chips domestically here in the U.S., in Europe, as opposed to China. So Intel announced in December it was investing $25 billion in Israel. And this is after getting $3.2 billion in incentives from the Israeli government. In June, Germany investing about 30 billion euros, that's $32 billion in semiconductor operations. And then this Apollo deal now is tracking a previous transaction with Brookfield Infrastructure Partners. That was a $15 billion deal. So you add all these up, we're talking about hundreds of billions of dollars, not only for Intel, but other foundries around the world. And that's because a lot of these chip companies don't make their own chips. NVIDIA doesn't make their own chips. And so this is about who's going to actually manufacture those semiconductors.
Certainly. All right. And Jared, rounding it out, let's take a look at Chevron. It is a trending ticker here on Yahoo Finance this morning. Senate Majority Leader Chuck Schumer, he actually called on the FTC to stop Chevron's proposed $53 billion acquisition of Hess. Schumer saying that the mega merger is going to give oil companies, quote, more fuel to raise gas prices. We aren't seeing much of a movement now here in Chevron earnings, but not necessarily a huge surprise when you take into account some of the rhetoric that we have heard from Schumer and his colleagues here over the last several weeks. But again, just at least this time, urging the FTC to stop this merger. We'll see.
Yeah, we'll have to see. This comes after a couple of big deals in the oil patch. Exxon just closed its deal with Pioneer. That was a $60 billion deal. That was its biggest acquisition in 2 decades. So this one with Hess that Chevron has been considering, this is a pretty big deal as well. It's to increase some of their foothold in Guyana. That's an up-and-coming field. The fields in South America by Venezuela, those dwarf what we have in Saudi Arabia and some of the Middle East. So there's lots to be done there, and we're just in the beginning stages. But it always comes back in the oil patch to returning shareholder capital. So they got to do buybacks, they got to invest in CapEx, or they got to do some kind of M&A, and that seems to be one of the later trends.
It certainly is. All right, Jared, thanks so much for breaking that down for us again. A deal that we're going to keep our eyes on and watch very closely here, because not only the impact that it will have specifically on Chevron, but also what Jared was just talking about, some of the broader industry implications as well. All right, well, Home Depot set to report earnings this week. It's going to give investors an inside look at the health of the consumer. Now, this report comes as higher rates have forced consumers to pull back on their spending. There was a new report out showing that home improvement spend fell more than 1% in the first quarter from a year ago. This is according to new data out from Harvard. So for more on this and what we could expect later this week, we want to bring in Daniela Bretthauer, Senior Analyst of U.S. Consumer Staples at HSBC. Daniela, it's great to see you here. So I think there's lots of questions from investors, just what exactly we're going to hear from Home Depot, whether or not the worst is behind it here for Home Depot and their rivals within the sector. What do you think?
Hi, good morning, everyone, and thanks for having me. Apologies, I have a little bit of a cold, too much traveling. But so the ability to spend is supported by a growing job market, and this remains quite healthy. Inflation has not decreased as quickly as the market was expecting, mainly because of elevated services prices. And inflation for goods, however, has dropped nearly to zero. So consumers remain focused on value and price, and they're shifting their spending patterns to make ends meet. So Home Depot sells higher ticket items. There was a lot of pull forward demand during COVID. And so they went through gradual decline in some of these bigger ticket items, which they say over $1,000. And so the year-on-year comps is not in their favor for this upcoming quarter. So we're looking at sales to decrease between 2 and 3%, and earnings anywhere between 2 and 5. And this is, again, because of the high big ticket purchases. And then you have interest rates, which remain high. And for new home buyers, that's an issue as well. In addition to all the structural headwinds that affects big ticket purchases decisions.
Yeah, Daniela, talk to us a little bit more about those larger structural headwinds, and then going off of that, just how long this will likely be an issue here for Home Depot and other larger players within the space.
Yeah, so specifically for Home Depot and Lowe's, which they operate in the same space, and they're very big on white goods, appliances and flooring and remodeling. So what has happened is people have either postponed or they've taken on this complex projects, the remodelings, but a lot less complex and with the tight budget. Whereas during COVID, you had the additional savings and people wanted to do these upgrades in their remodeling. So like I said, there was a shift in demand, and probably 2 years worth of demand has already been pulled forward. So I would think 2023 was the first sort of down year, and probably 2024. And the fact that rates remain high still, and the interest rates cut have been delayed. Probably we were only going to see one cut this year. So that doesn't bode well as well for people looking to buy new homes and or a switch. The fundamentals, they remain solid, meaning a lot of older homes that need upgrades, young population that, the baby boomers that now have more spending power, but everything seems to be on hold for now.
Daniela, let's switch gears here a bit and talk about Walmart, because yes, still a consumer-facing name, obviously, but I bring that up in contrast to what you were just saying, because you actually have a buy rating, you've maintained your buy rating on the stock, $200 price target. So even given all of those headwinds that you were just mentioning, you remain upbeat on this name. It's actually your top pick within the U.S. retail sector. Talk to us a little bit about why you're seeing that investment opportunity specifically within Walmart.
So Walmart has more tailwinds than headwinds compared to Home Depot. And like you said, that's our top pick in the sector. You have the positive tailwind would be this Easter calendar effect. So Easter fell in March this year, whereas in the year ago fell in April. So although the company is probably going to disclose the effect of this year-on-year calendar shift, is still quite positive. It's a very positive event, as a matter of fact, for grocery retailers. Costco just announced their monthly sales last week, and in their case, there was a 50 bips shift on the Easter effect, and we expect similar impact for Walmart. And just big picture, I think the future of grocery shopping is becoming increasingly omni-channel. And Walmart is America's largest grocer. They are very well positioned to serve the online. Yes, you have a big player online, which is Amazon, but in groceries, Walmart has a big advantage. And they're also opening a lot of stores. So the online to offline strategy works really well for Walmart.
Daniela, just to play devil's advocate a little bit here, if we were to see the Fed maybe further delay rate cuts, maybe not even cut until 2025, how big of a risk is that to Walmart? Yes, it might be better positioned than many of the other names within this space, but I guess what is the impact then ultimately maybe to their bottom line, at least in the very short term?
Yeah, one of the reasons why we picked this name for 2024 is also, well, first valuation, but also that we think it could be a defensive name in case the economy slows further, or the case of the interest rates cut being delayed. So Walmart, because everybody needs to buy groceries, so they can still do quite well. It's just a matter of their execution. They have the size, they have the strategy, they have the talent, and they have the price. So right now the consumers are value and budget conscious. Then, the everyday low price strategy works extremely well. And so I think that they can still do quite well and grow, have a nice growth in earnings this year. Like I said, more tailwinds than headwinds for this company.
All right, Daniela Brett Howard, thanks so much for joining us here this morning, Senior Analyst of U.S. Consumer Staples at HSBC. We'll keep it right here on Yahoo Finance. After consumer sentiment fell last week, the threat of the slowing consumer is weighing heavy on the hopes of a soft landing, potentially. We're going to talk to one economist to explain exactly what that means for economic growth. We'll be right back. Consumer sentiment taking a hit as inflation fears remain. Now, this month's prelim reading showing that sentiment actually fell to the lowest level that we've seen in 6 months. Here to break it all down, what exactly this is telling us maybe about growing weakness within the broader economy, if at all. We want to bring in Jeffrey Roach. He is LPL Financial's chief economist. Jeffrey, it's great to have you here. So talk to me just about that sentiment reading. I think spooked some investors, maybe to some extent here, just the fact that it did fall to the lowest level that we have seen in 6 months. But is there any takeaways that you're seeing just in terms of what that could ultimately signal about the health and the strength of the economy?
Well, good morning. Thanks for having me. And yes, I think it was interesting for investors because we got a little bit of confirmation from the conference board's release, told us something about consumers pivoting away from big ticket items. We got that confirmation in the latest survey from the University of Michigan. And I think what this tells us really is that the slowdown is starting to happen. But I don't know if we will understand quite the magnitude quite just yet as consumers do pivot away from those big ticket items. I think another thing that was a key driver for last week for markets was the latest estimate and blog post from the San Francisco Fed talking about excess savings being drawn down. So I think it's fair to expect the second half of this year is going to be running a lot slower than what we saw throughout 2023.
And Jeffrey, when it comes to the inflation prints that we will be getting later this week, specifically the CPI report, we are expecting to see maybe some easing when it comes to the pricing pressures that we have seen. But how long is it going to be until we see that material improvement that the Fed is looking for in order to be confident, maybe ultimately to cut rates?
Well, I think the Fed's looking for confirmation that the economy is slowing, so aggregate demand slows, which means consumers just aren't splurging as much. Hence, we'll see that pullback in pricing. It's been a tough time, and I think it's been a little bit of a disappointment because as we've all had to come to this realization that the 2% target that the Fed is looking for is going to take a lot more time to reach that target. We're not going to get to it as quickly as we originally thought. I think we'll end this year around a 2.8%. Again, it's above the 2% target, but we're going in the right direction. And I think that's where markets might respond quite favorably. In terms of Wednesday, so you're exactly right. This week, all eyes will be on another print from the CPI. It's not the Fed's preferred metric. The PCE deflator comes from the personal income and spending report. That's their favorite metric, but either way, this will be closely watched. I think one of the things you look for here is look past the headline. It's going to be supported by the rise in gas prices. Look at vehicle insurance and look at rent. I think we're going to start seeing finally the industry data flow through the official government stats and see rent prices start to ease a bit.
Jeffrey, will we see enough improvement in order to keep those rate cut hopes alive before the end of the year?
Well, probably not. So we had 3 consecutive disappointing reads. January was quite hot, February, March. So even if this comes in a little bit better than expected, I think policymakers will say, okay, look, we got to make up for all the disappointments the first 3 months of the year. But I do think one thing that we can say with a little more certainty is we can take the rate hikes off the table. Remember, just a couple weeks ago, there was a little bit of kind of clamoring and chattering about rate hikes. I think that's not going to happen, but we need to have a little more confirmation that we can get those 2 cuts. My view is we will get at least 2 cuts, perhaps not starting until September, but we'll start seeing the easing of inflation in this report, but we have to see some more confirmation in subsequent reports.
Jeffrey, I'm curious, before we let you go, I was talking to Mark Zandi over at Moody's about this last week, and he was making the case that 2% doesn't make sense maybe anymore, that should be the Fed's target. Maybe it should be something even higher, even floated the potential here of 3%. I'm curious, where do you stand in that debate, and maybe how much, whether or not there should be more of an emphasis just on the fact that maybe 2% isn't the new normal?
Well, it's fair to say, and I'll echo what some of my other colleagues say. There's nothing magical about 2%, but what is special is that global central bankers have agreed to that number. So if we have to start talking about inflation running a little bit hotter, particularly as demographics change, the structure of the labor force changes, perhaps it's not 2% anymore. But that conversation has to be a global one. It can't be just in the confines of this country.
All right, Jeffrey Roach, we'll leave it there. Thanks so much for hopping on and joining me here this morning. LPL Financial's chief economist. Appreciate it.
Thank you.
Well, coming up, Bloom Energy announcing a new collaboration with C3 AI to help broaden the scope and precision here of Bloom's product monitoring technology. We're going to explain exactly what that means, why you should care. We've got both companies' CEOs joining us for it after the break. Blink Charging getting a boost on the back of its quarterly results. Revenue soared more than 70% from a year ago. The company also acknowledging the slight drop that we have seen in EV sales during the first quarter, but despite that, remaining optimistic about the growth that the company expects to see here in the coming quarters. For more, we want to bring in Brendan Jones. He's the CEO and president of Blink Charging. Brendan, it's great to have you here. So talk to us just about the trends. Before we get into Tesla, that's a big headline that we want to get into, but more specifically, talk to us just about the trends that you have seen in your business the most recent quarter and whether or not that supports maybe this fear that we've seen about slowing adoption of EVs.
So yeah, we continue to see globally that EVs continue to be adopted. So it's a little bit of a different theme than you might see out there in some of the press in general. Specifically in Europe, our numbers are increasing dramatically, both in England, Ireland. We operate in the Netherlands and Belgium and moving into other countries. And the utilization rate and the penetration rate is 25, 30, as high as 35% in Europe. And that's the percent of car sales each month, each year of EVs representing. So that continues to increase. We did see a slowing down a bit in April on our sales side, but we haven't fully calculated net revenue yet. But that is buoyed by what we saw in Q1, which was increased penetration of EVs in terms of EV infrastructure going in the ground. We had we beat the previous quarter, same year, dramatically, as was indicated. So we see, though, in the marketplace, some consolidation. We definitely saw Tesla sales slow down a bit, but then we saw the other auto OEMs picking up simultaneously. And then in the quarter also, we saw an enormous investment from Hyundai Group that came in with another $50 billion in an effort to secure them as the number 3 automotive group. So you saw some, stuff that said, hey, it might be slowing, but then you also saw a lot of encouraging activity, said the space is going to continue to grow over the long term.
Brendan, there were some headlines that had investors at least a little encouraged maybe about what ultimately could potentially happen to your business. Now, there has been a bit of a flip-flop in terms of the headlines coming out from Tesla CEO Elon Musk. So I think some of the plans here may be in limbo for the charging network, the supercharging network. But ultimately, if we do see any sort of shift from Tesla, if we do see any of your competitors fully exit that business, what ultimately does that mean for Blink?
So first off, let's say what Tesla means today for Blink. It's the number 1 vehicle that plugs into our chargers today. Mm-hmm. So that's great business for us, especially on the chargers that we own and operate. And if Tesla slows down, we've already had phone calls and inquiries from a number of companies say, hey, can you pick up the pace? Can you jump in? And we're fielding those calls. And in many cases, we can. For Blink, Tesla's been heavy in destination charger, along with hotels, other municipal locations where they provide charging services and indeed sell chargers into. So those opportunities are presenting themselves to us today. And then in terms of fast charging, we may see, but that's going to be less of an impact than on the L2 side, the level 2 charging.
Brendan, before we get into some of the other details of it, would you then potentially consider hiring maybe some of these former Tesla employees who have been let go who are in this line of business?
Hey, Tesla's done a great job, right? Look at what they built, both here and in Europe. So if we have opportunities and we have a need, absolutely, we want to hire the best. And if there's people out there from Tesla that need a job and they're the best, we'll certainly do that.
Brendan, I hear your dogs are even getting excited about it here in the background. Talking about a little bit more about this momentum, maybe what this would ultimately mean for Blink's business. Very early days. There's still a lot of details that need to be ironed out. But you were talking about fielding some calls here just in terms of that interest. What have you been hearing? And I guess, is there any reason to be maybe a bit cautious on the fact that if we do see a shift here from Tesla, then your side of the business won't ultimately be able to meet the demand that's there right away?
So, yeah, we have capacity here in the United States. We have additional capacity built into our facility in India as well. So we can uptick. We've moved our Bowie, Maryland facility up to 50,000 units per annum is its current capacity on that. We have to add a second shift to do that, but that's already factored into our plans. So if the need comes, we believe that we can pick it up. But I don't think it's going to be Blink that picks it up. I think we're going to get our unfair share because that's who we are as a company. But the industry is going to pick it up as a whole. The independents, this is what we do. For Tesla, infrastructure is a cost of sale. For Blink, infrastructure is our business model.
And Brendan, real quick before we let you go, just about how much of EV adoption depends on lower rates? As we talk about this high for longer environment that we're in right now, a weakening economy, how much is that, if at all, going to push out maybe some of the adoption rates that we're expected to see?
Well, it depends on where you're located. Certainly, remember, we operate in both Europe and in the United States. So we're not seeing any impact in Europe. We continue to see increase. All business is good. In states where they're suppressing the adoption rate there's some political concerns, et cetera, we'll probably see some slowing. But in the big states who are driving EV adoption, like California, who has the 2035 mandate of no internal combustion engines can be sold there, past that date, you're going to see them continue to drive forward. We might see a month over month slowdown, and we might need to get past the election. But in the long term, we're going to see EV adoption increase as previously forecasted. Even McKinsey backed this up where they adjusted their forecast. They now say by 2030 it's 28 million chargers that are needed in the US. And that includes both L2 and DC fast chargers by 2030. So we remain encouraged and bullish.
All right, Brendan Jones, we got to leave it there. Thanks so much for taking the time to join us here this morning. Blink Charging President and CEO. We appreciate it.
Thank you very much.
Well, C3 AI is announcing a new partnership with Bloom Energy, using C3 AI's reliability suite to help broaden the scope and precision of Bloom's product monitoring technology. For more on this new collaboration, we want to bring in Tom Siebel. He's C3 AI's CEO and chairman, as well as KR Sridhar. He is Bloom Energy's founder, chairman, and CEO. Great to see both of you. I also have Madison Mills joining the conversation as well. KR, let me start with you, just in terms of we've been talking more and more, where there has been more of a focus on Bloom Energy recently when we talk about this energy transition, what ultimately is needed as we talk about the rapid adoption of AI. So why does this partnership make sense, and ultimately, what does it do for your business?
So three things out here, right? The first is, as our economy is growing, as we are digitizing everything, as transportation, like in your previous segment, is getting electrified, as AI and data center growth goes up, the grid is not able to keep up with the demand that there is. And one of the ways to solve that problem on a quick time to power is using distributed systems like ours to bring clean, reliable electricity right where the customer needs it. That's what Bloom does. Now, if you think about our deployed fleet, think about it as almost 20,000 small independent power plants operating in over 200 sites and producing enough power for 1 million homes. And imagine from each of these 1 million homes, 1,000 data points coming in every single day. So 1 billion data points are coming in, with which we can make sense and try to optimize better and make the products more efficient, last longer for the customer, and provide a better benefit. Now with the AI platform, Tom and I have been talking about this for a very long time. Finally, the time has come when we can take those billion data points from all the digital twins of things coming out of our power plants and optimize it better. That's what we're working on, and it is super important, not just for us. Once we prove this out, the future of electricity is going to be a lot of distributed generation, unlike one centralized power plant. This can be a model that everybody else can use.
Well, Tom, I want you to come in here because, as KR was just mentioning, C3 can really help its customers aggregate a lot of data. But the AI hype cycle has kind of quickly moved on from traditional use cases like aggregation of data into a desire for new products that can come from generative AI. So I'm curious, from your perspective, what is the path for C3 AI to become a generative AI play, and how long do you anticipate that taking?
Well, I think we're well beyond the AI hype cycle, and now we're in the AI implementation cycle at massive scale. And one of the largest applications of AI is to optimize the global grid infrastructure. And the grid would be the largest, most complex machine ever built. And so we could use AI to deliver cleaner, more reliable, safer energy into the hands of more satisfied customers at lower environmental impact. That being said, kind of globally, the people who operate the grid are kind of failing due to policy decisions, and the availability of power is becoming critical in Europe and in North America. So where we have the kind of work that KR is doing with these fuel cells, now we have tens of thousands of fuel cells are part of this grid infrastructure, and to optimize that infrastructure, we need to apply AI. Now, generative AI, how big is that? It's huge. I mean, the market for enterprise AI applications in power, in utilities, in oil and gas, defense, intelligence, manufacturing, that is probably growing to order of $1 trillion industry. Generative AI is another $1 trillion industry on top of that. And we're applying AI today, generative AI today in defense, in intelligence, in power distribution, utilities like Con Edison, New York Power Authority. We're working with generative AI with KR at Bloom Energy. And so generative AI changes everything. Yeah. But I do think we're well beyond the hype cycle in AI, and now we're in the large-scale commercial and industrial implementation cycle.
Really quickly, Tom, I know you've got a lot of revenue coming in from defense, like you mentioned. Where are you seeing more demand, from commercial or from government sectors?
Oh, commercial is by far our largest business. I mean, commercial is, energy, oil and gas, consumer packaged goods, travel, transportation. That would be government services. That's 80% of our business, state and local, but I would say defense and intel might be 15 to 20% of our business. That being said, it is rapidly growing. I believe we announced last quarter that year-over-year growth was order of 100%. So it's one of the, as we kind of reinvent the military complex in space, subsurface, cyber, contested logistics, what have you. AI is very much at the center of that. And we're very active in participating with the Pentagon in helping them get these services where they want them to be.
Well, given that, in our final minute, Tom, I'm curious. I know you've talked about how we're essentially at war with China here. 1 minute left. Talk to me about how worried you are about that headwind moving forward.
Be afraid. Be afraid. These people are competent. They're well financed. They're well trained, and they're focused. And they are, this idea, pure evil exists. Okay, it does exist. Okay, and these people, they plan on dominating us in AI, in chips, in cyber, in space, in subsurface, and AI is very much at the heart of this plan. And so we are in an open AI warfare with China today, and different companies are partnering with different players. We are partnering with the United States Department of Defense and their allies, and we're proud to do it, and hope that we win. But I would be afraid, and this is a very, very important, indeed, an existential issue.
All right, Tom Siebel, we wish we had more time. Thanks so much for joining us. And of course, our thanks to KR Sridhar as well. We look forward to hopefully having you back on Yahoo Finance in the future. Appreciate your time.
Thank you.
Let's do a final check of the markets here. Just about 90 minutes into the trading day. You're still looking at slight gains across the board. You've got the S&P just above the flat line, the Dow adding 30, the Nasdaq up about 0.3%. Coming up next on Wealth, you've got Madison Mills for the next hour. She will be dedicated to all of your personal finance and needs. She's got more on that when we come back.
Welcome to Wealth. I'm Madison Mills filling in for Brad Smith today, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, Inflation Explained. We'll break down what inflation means for you and speak to an expert about how you can still make the most of your money amid those higher prices. And housing hurdles, what high interest rates mean for your mortgage and your investments. Plus, those FAFSA delays. We're going to talk to an expert about the impact of students making decisions about their education without knowing the full details of their aid packages. We'll get a fresh read on the state of price increases out this week with April's consumer price index. That's going to inform the Federal Reserve's path forward. Let's take a step back and look at what inflation is with our team coverage here. I'm joined by Yahoo Finance's Brooke DePalma and Jennifer Schomburger for more. Now, inflation, what is it? It's a measure of how quickly prices are increasing over time. One example here, the Big Mac, released in 1967 for just 45 cents. Today, The Economist puts the average price of a Big Mac in the U.S. at $5.69. So the reason for that change is inflation. Now, what causes it? First of all, an increase in the supply of money, which makes money lose its purchasing power. If there's too much of money sloshing around, it becomes less valuable. 2, an increase in demand, which leads to price increases. The more people want something, the more companies can charge for it. Now, 3, an increase in production or supply chain costs, which are passed down to the consumer in the form of high prices. And lastly, an increase in wages can cause inflation by making services more expensive. Now, here are 3 ways that inflation is measured. PPI, or the Producer Price Index, that looks at the change in how much companies are charging for goods and services. CPI, or the Consumer Price Index, measures the weighted average prices of a big old basket of goods and services that consumers spend money on, like transportation, food, medical care, and even manicures are included in that as well. And then there's the Fed's preferred way to measure inflation, which is PCE, or Personal Consumption Expenditures. Now, that's a measure of household spending on goods and services. CPI and PCE, those acronyms, they might sound familiar. Here's why they're different. They use different formulas for one, but the big difference is their scope. They measure the prices of different stuff. Now, the so-called core PCE is the Fed's preferred measure of inflation because it's seen as less volatile, but the criticism is that it doesn't always paint an accurate picture of how we are feeling about the state of inflation. So now that you have a good understanding of what exactly inflation is, we're going to hear about how it affects your money.
Well, certainly, we're going to talk about how inflation affects your purchasing power here. And over time, prices inflate. And your dollars, well, they don't go as far as they used to. So that means you need more money to buy the same exact goods and services. Let's think through this with that Big Mac example that you had mentioned earlier before. If it originally cost you 45 cents and now it costs you $5.69, your dollars aren't going as far. You essentially need more money to buy that same exact hamburger that you got years and years and years ago. As another example, you spend $100 weekly at the grocery store on the same exact items. Well, now that same exact grocery list costs you about $125. You're not buying more items than you did a few years ago, but your dollars aren't taking you as far. And that can have a big impact on your savings. If you have to pay $25 more for your weekly grocery trip, that's $25 that you no longer have to pay your phone bill or contribute to your savings account. And that's how inflation, the rate at which prices change, impacts your ability to spend.
So then how do you control inflation? Typically, that's the job of a country's central bank. And it's done through monetary policy, which refers to actions that policymakers take to raise or lower a country's short-term interest rates. To quell inflation, the U.S. Federal Reserve raises short-term rates, which push up U.S. Treasury yields, which in turn influence longer-term interest rates on everything from credit cards to homes. That makes it more expensive for consumers and businesses to borrow money, finance purchases, and make investments. That acts to lower demand for goods and services in the economy, curbing spending and pushing down overall inflation.
All right, my thanks to Brooke DePalma and Jennifer Schomburger for those explanations there. Now that we've got a better understanding of inflation, it's time to examine what everyday Americans can do to protect your savings and retain your purchasing power amid those higher prices. Joining me in studio for more is Joe Orff, WealthStream Advisors Director of Investment Research. Joe, thank you so much for being here. I appreciate it. Let's start on the inflation picture here. You really want a Goldilocks scenario, not too hot, not too cold. Explain to us why it would be a bad thing for prices to drop rapidly, because right now that sounds pretty good.
Yeah. So it's an interesting question. So for prices to drop rapidly, we'll see inflation come down. So everyone's seeing this inflation report that's coming out later this week. We're expecting 3.4% inflation. It's coming hotter than expected this whole year. At the beginning of the year, there were estimates that the Fed could cut rates 6 times this year.
Yeah.
Now that expectation is down to 3 hikes, potentially. There's a lot of up in the air scenarios about where inflation is going to be and where it's going to go from here. And one of the main sticking points is really the housing impact and the rental cost on inflation. How rental costs haven't come down as quickly as everyone thought.
Yeah. So again, though, in terms of for our audience that's looking at this from a wealth perspective, I am curious about what consumers can be doing to hedge against inflation. For a consumer that right now has all their money parked in their bank account, what could they be doing differently?
Yeah. So the one thing that we recommend to all of our clients is to move money out of your normal checking and savings account that's really paying you pennies on the dollar, moving it either into an online savings account, Ally Bank, Barclays, Discover, Amex. If it's a savvy investor, they could even buy direct treasury bills that'll yield a little bit more.
Okay, so that's 2 parts to that. One, how do you decide the right high yield savings account for you? Should you just go with the one that has the highest yield?
So I don't think you should go with the one with the highest yield. There's some online savings accounts out there that are advertising 6, 7, 8% yield.
Yeah.
That's significantly more than the Fed rate of 5%. So there's going to be some additional risk in there. You might not see it today, but if everyone wants their money out at the same time, there might be an issue with getting your money out of some of those institutions.
There might be a liquidity issue, right? And you have to make sure it's FDIC insured as well. That's a big component that you mentioned. Buying treasuries, how good does your investor hygiene have to be to go from that next step, right? Not just high yield savings, going into CDs, going into treasuries.
Yeah, so treasuries, you definitely have to be more on top of it. So you buy a 3-month treasury yielding, say 5.4, 5.5% right now. 3 months goes by, you're gonna have to manually buy another one. You have to set alerts up for yourself to constantly roll those treasuries. Whereas if you put in an online savings, it's a one-time transfer. You don't have to touch anything again.
Okay, and then last question for you. I'm curious about asset allocation varying across different age groups. Right now we have this record-breaking rally in the stock market due to AI and big tech. For those that are nearing retirement and their portfolios naturally kind of reallocate to be more bond-heavy than stock-heavy, should they go in and manually change that?
So it depends. So the way we look at client asset allocations is on 3 factors: time horizon, required rate of return, how much money they need to earn to accomplish their goals, and their risk tolerance. So some clients who are older might have a really high risk tolerance and they'll be okay owning more stocks than bonds, and they're okay with big drawdowns, whereas other clients might not be. So to say it's a blanket answer, as you get older you should be more conservative, isn't necessarily the right answer.
Depends on that risk appetite. I love the idea of just setting my required rate of return. Like if I could do that, that'd be great. Let's make it 200%. Joe, thank you so much. Really appreciate you joining us in studio. Thank you. That was Joe Orff, WealthStream Advisors Director of Investment Research. Now, for all the justifiable fears that Americans have about inflation, it's not the first time the country's experienced rapid price increases. But it may be the first time in our lifetimes here, but we've been here before and we were all okay. So what can we learn from past inflationary periods? To help us answer that, we've got a fantastic guest. He's the former Assistant Secretary of the Treasury for Economic Policy. He's also the current Brookings Institution Vice President and Director of Economic Studies, Ben Harris. Ben, thank you so much for being here. We really appreciate it. To understand this moment in time, help me out here. Walk me through another moment in history where we could tame record-breaking inflation and we did end up okay.
Yeah, so we have had one other notable period of elevated inflation in our country's history, and that happened in the 1970s and early 1980s. Now, that inflationary period lasted for roughly a decade. This current inflationary period, we were only about 5% inflation for about 20 months. versus 10 years going back to the 1970s, early 1980s. And inflation, the peak inflation in that period was much higher. It was around 14%. So inflation only peaked at 9% this time, 14% before. It was 10 years before. It was only about 2 years for this time. So it wasn't as severe, but some of the lessons were the same.
So what was the biggest headwind for inflation at that time? What was an effective strategy for taming it? And to what extent do you anticipate us being able to replicate that similar strategy, given that we're in a very unique time period here?
Well, you mentioned it earlier. We have one big tool for fighting inflation in general, and that's monetary policy. And so the Federal Reserve raises interest rates, and will keep interest rates at what it deems to be an appropriate level until it has brought inflation down to around 2%. One of the really good news stories that's come out of our recent inflationary episode has been that households and investors and people who participate in the economy believe in the Fed's credibility. So if you ask households, do you think that inflation will stay around 2 to 3% over the next 1 year, over the next 3 years? People say yes. I mean, that's one of the really troubling things with inflation is that if people start expecting prices to keep going up and up and up and over time, then they start changing their behavior in really problematic ways. Workers start saying, look, I want to account for this inflation in my next raise. Companies, when they're setting prices, say, okay, we expect prices to go up over time. Let's build in those price increases. And then you get this problematic spiral over time that makes it much harder for the central bank to do its job.
Well, this is like my favorite debate ever, Ben, is whether or not the Federal Reserve has the amount of power that we think they do to tame inflation, because they really got two levers: monetary policy in terms of the interest rates and in terms of quantitative tightening and easing of the balance sheet. At what point do we consider that we need some fiscal policy, some changes from the federal government to put a cap on inflation and prices going up at the company level?
Yeah, so fighting inflation is really a job of the Fed. And the Fed has made a lot of progress so far. So again, in the early part of the pandemic, we were at 9% inflation. That was incredibly troubling and it was honestly scary, I think, for a lot of households. That's come down so far. And so we're now at the last mile. We're around 3.5% for the CPI, a little bit lower for the PCE. But inflation has already come down a lot, in large part to the good work of the Fed. So the big question now is how much additional higher rates do we have to go through in order to get inflation down to 2%? Now, investors still expect 1 to 2 cuts over the course of 2024. As your prior guest said, that if we were speaking a few months ago, we might have expected 4, 5, or even 6 cuts. So you're hearing this term higher for longer, which is just the expectation the Fed will have to keep rates elevated around the 5% range for a bit longer. And households will need to account for that when they're thinking through their budgets and they're thinking through their own personal forecasts. But right now, to get to your direct question, it does seem that the Fed has made an enormous amount of progress over the past couple of years, and that we're pretty close to its goal.
Well, it's interesting hearing your kind of positive take on what the Federal Reserve has been able to do, because the consumer's not necessarily feeling that way. 80% of Americans say prices are still causing pain, according to this new poll from the Financial Times. We've got wages up, record-breaking low unemployment. I mean, what gives here when it comes to the negative sentiment that we're seeing amongst the consumer?
It's such a great question. So the first thing is that people are not accurately reporting inflation by and large. So there was some research coming out of Brookings by Stephanie Sanchiva, and she polled people and asked them just what was inflation over the past year. And so at the time of the poll, inflation was 3.4%. And half of the people thought it was more than 5%, and a quarter of the people thought it was more than 10%. Wow. So of course people are frustrated with inflation if they think it's 10%, but it's only 3.4%. So part of that is just misunderstanding the levels of inflation. The second big misconception around inflation is that it does benefit a lot of people. Look, if you're a household that has a big share of your payments going to a mortgage and you have a fixed payment, and your wages are rising with inflation, but your mortgage payment is staying the same, there's a pretty good chance you're going to be benefiting from higher rates of inflation. So inflation tends to have winners and losers, but not everyone's a loser.
Really good point, Ben. One last question for you. I know that when current President Biden was the vice president, you were his chief economic advisor from 2014 to 2016. One thing that's been interesting from the Biden administration is they're really owning some of the good data out there. Record-breaking low unemployment, wages keeping pace with inflation. If you were his current economic advisor, what would you tell the administration that their messaging on inflation should be?
That's a great point. So I think that they are messaging it the right way, but some of the stuff is just not getting through. And so to take one example, my old group at Treasury, the Office of Economic Policy, a few months ago put out a report that made the point, which is just simply facts, that the typical worker has an extra $1,000 in purchasing power relative to 2019. And that's because wages have been going up so much faster than prices. And so I think it's important just to give an accurate, fulsome view of the economy, to point out that, yeah, along with this problematic elevated inflation, we're seeing record low unemployment. We've had a massive wealth boom in this country, not just at the very top, but for middle class families as well. And that we're doing much better than our competitor countries. Look, the U.S. economy right now is the envy of the world. And so, my advice to the administration is just to continue telling the true story, which is that the U.S. economy is not perfect, but there's a lot of good news out there.
All right, Ben, thank you so much for bringing us the optimism this morning. We appreciate it. That was Ben Harris, Brookings Institution Vice President and the Director of Economic Studies. Now coming up, more housing hurdles. Home buyers are facing rising interest rates, low inventory, and still high prices. There's another way to play the housing market. We're going to have more on that after the break. do check of the market, sponsored by Tasty Trade. Looking at green across your screen, the Dow's up 48 points. The S&P actually looking a little bit flat, but still on to the green side there. The Nasdaq, the tech-heavy Nasdaq, up about 0.2%. Some interesting inflation data. We've been talking about inflation all morning. The New York Fed's survey of inflation expectations for 1 year's time jumped to over 3.2%. It was 3% over the last couple of months, so that becomes the latest gauge of consumer sentiment on inflation, coming in a little bit worse than anticipated. Consumers still feeling those rising prices, and that is impacting that sentiment. Now, home buyers are looking to navigate higher mortgage rates as the average U.S. 30-year mortgage rate still sitting above 7% here. That is according to Freddie Mac. When interest rates are high, some borrowers may choose to pay down the interest portion of their monthly payments to make their monthly mortgage a little bit more affordable, but that also comes with risks. So for more on paying down your mortgage here, I'm joined by Greg McBride, Bankrate Chief Financial Analyst. Greg, thank you for being here. I mean, talk to me about what I just mentioned. Should consumers who have the ability to pay down that interest be doing that?
For a lot of mortgage borrowers that are walking around with the 3 or 4% rates, it just flat out doesn't make sense. You're using somebody else's money with rates that low. Even if you did take a mortgage recently, say 7 or 8%, even then, it may not necessarily be in your best interest to accelerate payment. Only 1/3 of American households actually have an adequate emergency savings fund. So most people are undersaved for emergencies. In that sense, pouring more money into an illiquid asset, your home, that you can't get to if you need it, that is not necessarily the step you want to be taking, particularly if you can be increasing contributions to tax advantage retirement savings or paying down other higher cost debt.
Well, talk to me about that, Greg. Let's say that you're a consumer that's got your emergency fund ready to go. At that point, should you pay down the mortgage or still say, hey, let me put it in the stock market, better returns there?
Well, let's think of it from the standpoint of diversification. You don't want all of your wealth or even the lion's share of your wealth tied up in your home. So if you've been in your home for some period of time and you have a lot of equity, you don't necessarily want to be pouring more into that and growing your equity stake further, particularly if you're not taking full advantage of those tax-favored retirement savings plans. On the other hand, where it can make sense, let's say you're getting down towards the end of that mortgage, you're down to your last 10 or 20,000 on the balance, and you're a couple of years away from retirement. In that sense, stepping up the payments can make a lot of sense, because what you're going to do is you're going to completely eliminate that payment before you retire, giving you a quick return on investment, drastically reducing your expenses in retirement. Another instance where paying ahead can make some sense. If you want to get yourself below a key loan to value threshold, say 80%, where you can eliminate private mortgage insurance or put yourself in a position to get a better rate when rates drop and you look to refinance.
So I'm curious then, there's this idea out there that you can date the rate by the mortgage. You should worry more about the home price than the rate because you can always refinance later on. Is that still true?
It is true. I think, there's this expectation that mortgage rates are going to decline, and that when that happens, anybody who took out a rate at 7 or 8%, that they're going to be storming in to refinance. We're still waiting on that to happen. Mortgage rates have actually gone up so far this year. That's kind of defied expectations. I do expect that they will eventually come down as inflation comes under control, but that timetable's been put off a bit. So as those rates come down, I do think you're going to see anybody who's taken out a mortgage over the last couple of years, they're suddenly going to be in the market to refinance, and they could be in the market to refinance multiple times if rates were to continue dropping.
And then last question here, Greg, for those of us, myself potentially included here, who just feel like with these rates, it's just like not on the table realistically to be buying a home anytime in the near future, what advice do you have for us?
Well, it might not be in the cards right now. Home prices are high, financing costs are high, the selection is very limited, not a great time to buy. But what you can control, investing in yourself, getting that training or certification that positions you for that next promotion, that increases your future earnings capability, that's what could suddenly make home ownership much more tenable 12 or 24 months down the road, even if home prices or mortgage rates don't necessarily cooperate.
I like it, Greg. I should look into the MBA more than I should look into the mortgage. Really appreciate it. Thank you so much for joining us. That was Greg McBride, Bankrate's Chief Financial Analyst there. Now, sticking with the housing market, houses are getting smaller, new homes are shrinking as America's home builders try to give buyers some more affordable options. Yahoo Finance's Danny Romero has more on how much smaller these homes are now. Danny, what do you have for us?
Maddie, the strategy to build smaller homes is entirely affordability driven. Buyers, especially first-time home buyers, are dealing with high home prices, rising mortgage rates, and low inventory. And so building smaller homes allows builders to keep prices down. So what is the average square footage of a new home? Data from the Census Bureau shows that the average new home is about 2,374 square feet in the fourth quarter last year. Now that is lower than the 2,468 square feet reported in the prior year. So that's a 94 square feet difference, the size of a small secondary bedroom. Now, if we compare that to the home builders like D.R. Horton, one of the biggest home builders out there, they reported that the average square footage for homes closed in the most recent quarter was 1,980 square feet. That is significantly lower than what the Census Bureau has reported so far, Maddie.
So I'm curious about kind of what the impact of that might be on the prices from the consumer perspective, but more broadly, how are builders able to achieve these smaller houses? Like, what exactly are they taking out? Are they taking out a second bathroom? What is it?
Close, Maddie. It's all about thinking creatively. And so designers are actually replacing multiple living and dining spaces with eat-in kitchens and flex spaces. So that allows them for the kitchen to be a lot bigger, a lot more open space. Another trend that consumers are really liking is that they want less dead space in their primary bedroom. So they really are opting for a built-in workspace. Another thing is that bathrooms are staying similar in size, but another thing is that consumers are saying, you know what, we don't really want a bathtub, so I guess no bubble baths for these consumers. Another thing I just want to wrap it up here is that Taylor Morrison, another home builder, said that they noticed that consumers are not really using foyers, front porches, or oversized bedrooms. And so that really allows them to kind of shrink the size of a home. But overall, I did speak with one customer who did buy a new home recently from Taylor Morrison, and she said that she was really focused on building wealth and equity rather than really the size of a home, Maddie.
All right, it's interesting, Danny. Us New Yorkers know the room for a bed dynamic very well, so interesting to see that spreading out. Thank you so much. That was Danny Romero from our very own Yahoo Finance. Appreciate it. Now, coming up, how to invest in the housing market amidst these high interest rates. We're going to explore how you can cash into the space without buying a home. That's coming up after the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Home ownership is becoming less attainable thanks to rising mortgage rates and low, albeit recovering inventory. 57% of renters agree that the American dream of owning a home is dead. That is according to a Harris poll. If you want to invest in the housing market without buying a home, though, there is an alternative. Real estate investment trusts, or REITs, could be your way in. REITs are publicly traded companies that own, operate, or finance income-producing properties. And you can invest in REITs the same way you might invest in specific companies. For more on playing the REIT space, we are joined by Jameson Manwaring, Neighborhood Ventures CEO. Jameson, thanks so much for being here with us. Start us off with what exactly investors need to know about what a REIT is before they start investing.
Yeah, a REIT gives you the opportunity to invest in a pool of assets. And you can invest in multifamily REITs, you can invest in office REITs, you can invest in a mix. It depends on what your appetite is. And one of the important things with REITs is there are many that are publicly traded, and then there are many that are not publicly traded. Mm-hmm. And the ones that are not publicly traded, like the one we do at Neighborhood Ventures, doesn't have a correlation with the market. And typically a publicly traded REIT, even if the underlying assets are performing well, it may go down along with the rest of the stock market because it's publicly traded. So there's a big distinction there. But it gives you the opportunity to invest in housing, for example, even if you're a renter. Now you can still be exposed to the housing market, start to build that equity. And we have a lot of younger investors who are renters, but they're investing in our REIT to start building their equity in housing.
So talk to me about how those younger investors are finding the ability to invest in private REITs like your own, given that it's not on the public market. It's a little bit and can seem a little bit less accessible to investors.
You know, things have really changed with social media and online content. People find us every day, but they have to do a little bit of research. It's not that difficult now, though. If you put in, REITs online, you'll find us and you'll find our content and other companies like us. We do a lot of education. Yeah. So investors know what they're investing in. And then we have investors can begin investing with as little as $100 a month, and they can put that on an automatic investment on the 15th of every month. They can begin investing a little bit. And then we have investors that invest, several $100,000 as well. So it's a great way for all types of investors to invest. But things have definitely changed. Younger folks are not looking, and I'm talking kind of the more millennials and down. They want to do the research themselves. They want to have control over what they invest in. They're not looking for a financial advisor to control what they invest in any longer. And companies like ours are really benefiting from that.
Well, it's interesting. A lot of investors may not even know that they're already allocated to REITs, particularly through their 401ks. Almost 100% of them have REIT allocation. But when you look at REIT shareholders by type, a little over half are through mutual funds or ETFs. What should investors know about going the ETF mutual fund route to get that asset allocation versus investing in individual names in the REIT space? What is that risk-reward ratio looking like?
Most investors who have invested in REITs a lot would prefer to have more visibility into what that REIT is investing in. And a lot of these very large REITs, they don't give a lot of detail about which specific buildings are in there. So it's kind of like investing in just a big ETF.
Right.
There are the alternative, if you were to compare it to like a single stock or more of a basket of stocks, is when you do invest in a privately traded REIT. So ours, for example, we're only investing in multifamily, typically in the Southwest. And we know that's where the migration of people is moving in the US. We know that's where the growth is happening. So you can get some really nice specific exposure, still get the diversification in a non-publicly traded REITs. And there are many out there like ours.
All right, Jameson, we're going to have to leave it there. Thank you so much for joining us. That was Jameson Manwaring, Neighborhood Ventures CEO, joining us on All Things REITs. Now, coming up, Walmart set to report their earnings later this week, how you, the consumer, should be reading their report, and what it can mean for the inflation picture. That's coming up next on Wealth. As earnings season rolls on, one of the biggest companies set to report this week is Walmart. For more on what their earnings could mean for inflation and how much you may be spending next time you head to the store is our own Josh Lipton. Hey, Josh.
Maddie, good to see you. So how much have our friends and neighbors been shopping at Walmart exactly? Well, we're about to find out here. On Thursday, Walmart is expected to report Q1 results. Wall Street is looking for earnings per share of 52 cents on revenue of $159.4 billion, representing an increase year over year of 4.7%. Now, we care about Walmart, of course, because it is the world's largest retailer. And because of that, Walmart is seen as a true bellwether for consumers, a gauge on how they are feeling and spending. Heading into this report, that stock is up about 15% this year, and analysts who cover Walmart are big fans. Nearly 90% of them think you should buy the stock. I checked in with one of those analysts, CFRA's Arun Sundaram, and asked him what he's going to focus on in this report. For one, he says the retailer's U.S. comparable sales. Arun estimates they will rise 3.8% year over year. Now, that would actually be a slight deceleration from the last time Walmart reported financial results. Walmart shoppers have been feeling generally more cautious, he says, due to inflationary pressures and an uncertain economy. They're still spending on necessities like groceries, but not as much on higher margin items like clothing. Now, despite that deceleration, Arun says he expects the company's total gross margin to actually expand in the quarter to 24.8%. In part, that's because Walmart is now growing higher margin services businesses faster than its core retail business, such as digital advertising, third-party marketplace fees, and fulfillment services. Investors focus on these new profit streams because they carry much higher margins, and over the next several years, the bet is that they will represent a larger share of the company's overall business. A final focus for Walmart investors in this report, the company's financial forecast. What are they going to say about the quarter and year ahead? Arun expects Walmart to raise its annual guidance, but if they do not, he says, investors might view that negatively, Maddie.
All right, Josh. Well, thank you so much, as always, giving us the retail beat. Thank you. Really appreciate it. We're going to have much more on wealth right here after the break. You're watching Yahoo Finance.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In late March, Walmart stock reached a record closing high of $61.45 per share, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Applying to college can be really stressful. So when the Department of Education announced a new FAFSA for student aid, many prospective college students were hopeful that the process could become a little bit easier. Not so much. The rollout of the new form was marred by technical delays that prevented students from accessing them. Now millions of students have to decide where to go to college without knowing how much it could cost. For more, we're going to bring in Bill Townsend, College Rover founder and CEO. Bill, thank you for being here. And just to take a step back, this is the free application for federal student aid. That form was rolled out, had a lot of issues. Now all these students have to decide where to go to college without knowing how they're going to afford it. And this is really heartbreaking to me, because when I got into college, I wasn't even excited until I got my FAFSA information back and knew I could afford it. What is the impact that this could be for the millions of students out there who don't know if they're going to be able to afford to go to the college they got into?
So, Maddie, first, thanks for having me on. This impact is actually devastating. About 80% of high school seniors who then apply to college and don't go that first year, especially first generation and low income families, end up never going to college. So if you look at this, the estimate is about 16% of the freshman class for next year is adversely affected by the FAFSA rollout. If 80% of that 600,000 number don't go to school, the effects are tremendous. If you think about it this way, 500,000, 400,000 kids never go to college. They never maximize their earning potential. And we have a workforce issue, and we have a demographic decline coming 2028, where because of the credit crisis in 2010, we're already going to have less students going to college. And the ramifications of this are for individuals, but also if you look at Social Security, not having enough workers, trained workers and skilled workers, affects really the entire society.
Bill, what you just said is so important, so let's pause on that. What do you think is the single biggest economic impact that we could see just from this FAFSA issue alone?
Okay, so I've tried to do some research in looking at specifically of undocumented families. So one of the issues is FAFSA used to be based on your parents' income. Now it's based on income and wealth, trying to factor generational wealth in. But the new version, unfortunately, you have to have Social Security numbers for both of your parents. So let's say one of your parents is undocumented. You cannot apply for FAFSA right now. So this is an absolute disaster for U.S. citizens, students who were born here, U.S. citizens, because of your parents' documentation. You can't apply for FAFSA, which means a lot of those kids are never going to go to college, especially if you're low income. The thought of taking a gap year, doesn't affect. You have to go to work. You have to support yourself.
Yeah.
And so the effect is tremendous. And in some ways, I wonder if it was deliberate.
What do you mean by that?
Well, somebody made a conscious decision to change the form to require Social Security numbers from both parents. My question is why? So when Lamar Alexander stood up in the Senate a number of years ago with the FAFSA form and said, we need to simplify this, this was going to be his legacy, who made this decision to suddenly exclude families with a parent who's undocumented? Richard Cordray is not re-upping his term on the FSA, Financial Student Aid group that he's been running, which is another issue because you now need to fix a system that's broken. You have a new leader coming in, and who knows what their objectives are. It's become very political on both sides of the aisle, and something that should never have happened.
Well, college campuses enjoy touting the idea of a diverse set of students, both economically, ethnically as well, really across the board. Can colleges do anything to come in here and be helpful?
Well, it's interesting. So I was actually talking to the University of Memphis, and they've got 40% of their students get Pell Grants. That's actually going to go up. They're projecting that could be close to 50%. And Pell Grants are part of what FAFSA is determining. So they started 4 months ago having seminars for local residents, Shelby County and then adjoining counties, to try and make up for the fact that this was a debacle. Andrew Lynn, their head of financial aid, this morning confirmed that they think they're going to be able to close the gap. Smaller schools, though, let's say Rhodes College, and they've got a much lower percentage, 15% of the students ever getting a Pell Grant. But still, if you look at this, the freshman class typically there is about 450. If they lose 10 students, that directly impacts, their tuition, even if it's just partially paid.
Last question for you, Bill, in our final minute together. This comes after a lot of volatility on college campuses, and it makes me wonder how young people, how teenagers might be thinking about the ROI of a college education. What would you say to those young folks who might be listening?
It's very interesting. So keep in mind the FAFSA debacle also affects trade schools. Okay, so if you want to go to cosmetology school or become a phlebotomist, you're getting a Pell Grant for that. So it affects really the entire chain here. I think that if you look at the survey, students are very disillusioned with Congress. They're disillusioned with the political system. They're disillusioned with the results. I think this will continue to drive them out of the system. If you look at college earnings for college graduates, the better schools you go, the better the school you go to, the higher your income is. So I think that students are going to have to really look at that, especially for some of the for-profit schools, which in many cases are great schools, but in some cases have proven to not be very good for individuals or society.
Yeah, it's just tough. The stakes are high and the barriers to entry are increasingly difficult, as we're talking about here. Bill, thank you for joining us. That was Bill Townsend.
Thank you, have a great day.
Thank you so much. Bill Townsend, College Rover founder and CEO here. We're going to do a final check of the markets here, taking a look at some more green across your screen. The Dow just about flat, the S&P 500 also about flat. Not a lot of conviction or volume in this market today. The Nasdaq, though, up about 0.3%. We're also seeing some moves in the bond market ahead of more record-breaking auctions as well. That's going to be it for Wealth. I'm Madison Mills. Thanks so much for watching. Brad Smith will be back with you later on this week. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern, and you won't want to miss it.